My name here in New York City on this Friday, December 13th. Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Shauna Smith alongside Brad Smith, and let's get you the three things that you need to know today.
Good morning, everyone. First up, Elon Musk renewing his long-standing feud with the SEC by posting a letter that the agency sent him on his X account. The commission this week reopened a probe into Neuralink and also said that the SEC is preparing to take action against him related to his investment in Twitter before he bought the platform in 2022. The regulator has been examining the timing and disclosure of Musk's purchase of Twitter stock before he acquired the company for $44 billion. The letter said that the agency gave Musk a 48-hour deadline to accept the settlement over the probe or face an enforcement action.
Plus, U.S. stocks looking to open higher as tech leads the gains to end a strong week for the sector. Technology stocks hitting fresh records this week, but the Dow falling for 6 days in a row. That's the longest losing streak that we've seen since April. This coming as overall market breadth is showing some signs of deterioration, more stocks actually falling than rising. Investors now looking ahead to the Fed rate decision next week.
And Broadcom shares are surging this morning after the semiconductor company predicted a boom in demand for its artificial intelligence chips. AI product sales will gain 65% in the first quarter, far faster than its overall semiconductor growth of about 10%, according to the company. Meanwhile, Costco getting a slew of analyst upgrades today as the company posted quarterly profit that beat expectations, showing the big box retailer remains unfazed by tighter consumer spending. The results reinforce Costco's unique position among retailers as its affluent customer base, which is willing to pay an annual membership, helps to insulate the company. Magnificent Seven stocks on a tear this week with several names hitting all-time highs. With us to discuss what's behind this record rally, we've got our own Josh Schaefer here. All right, Josh, what's going on here? It just seems like seven names continuing to make up more share of the S&P 500.
Yeah, we're back to the 2023 playbook, right? Not actually, but we're talking about seven stocks leading the equity market higher. Should we all be nervous about this? What is going on, right? So I posed that question to a couple strategists this week, and there's really a couple factors at play. The first one I would point to, guys, is think about the macro narratives we've been talking about over this past week. We've been talking about the potential for higher for longer from the Fed, maybe higher inflation. Well, what's worked in that playbook over the last 18 months in a period of high inflation, in a period of higher yields? You look at the 10-year yields at its highest level in about 3 weeks now. It's risen about 20 basis points through December. We've been talking about a Mag 7 rally through December. Part of what a lot of strategists recommend in a period like this is I want to go up in quality, up in cap spectrum, right? I want to go for large cap companies that have a lot of cash flow that actually could benefit from higher rates, and tech has benefited from higher rates. So you're seeing flows into it from that perspective. There's, of course, we talk about them as a group. There's individual stories going on here, right? Tesla certainly has a lot going on with its different car announcements that are coming out, with Elon Musk tied to Donald Trump. All of that sort of driving that part of the stock. You have the quantum chip coming out with Google and Alphabet. That's sort of driving its own narrative. But the other thing I would argue when you talk about just the fundamental case for these stocks, right? We talk a lot about that chart, the 493 versus the S&P 500 or versus the Mag 7, right? There's this chart that we always talk about where the 493 are supposed to pick up in 2025. Earnings growth is supposed to pick up, and the Mag 7 is supposed to see earnings growth decline. Well, when you actually look at estimates and where estimates are moving, the revisions for the current quarter, Mag 7's holding up better than the S&P 500. Mag 7's holding up better than the 493. So right now, if it's a show me story from a fundamental standpoint, Mag 7 earnings are holding up better than everyone else, and if earnings are one of our key drivers of stock price performance, it's not hard to understand why, okay, there's still some strength there, and we kind of have to wait to actually see the weakness, and maybe even more so, see the strength from these 493. Right now, we're talking about estimates, not necessarily what's happening.
Exactly, and I think that's key, right? If you're there trying to figure out just how, whether or not this momentum that we have seen, at least as of late here, can really be sustained. I guess my question is, when you take a step back and talk about the risk profile then of the market, just how investors should be viewing this fact, the fact that there is so much uncertainty, the fact that there is so much riding on what exactly the earnings results are going to tell us specifically from just a handful of companies. Is there at all just sort of a reevaluation going on just in terms of maybe the volatility that we could see, or maybe further rotation that we could see then in the latter half of next year? Maybe?
Yeah, so part of the reason we talk about how many stocks are going up and how many stocks are going down is because people would tell you that's a sign of strength in a rally, right? A sign of strength in the bear market. So the S&P 500 has had more decliners than advancers for 9 straight days now. That's the first time that's happened since 2001. And essentially what the argument would be is it puts the rally on a little bit thinner ice. You have less support from all of these other stocks if, say, what if bad news comes out of, I don't know, I don't want to say bad news about any of these companies, but what if bad news comes out of China and it hurts NVIDIA, right? We've seen that happen plenty of times. And so then NVIDIA falls and NVIDIA has been one of your key drivers, then you're just on less solid footing. Mm-hmm. So I think it will be interesting to see specifically maybe once we get past next week's risk event with the Fed and we get a little bit more of a clear idea potentially of what they plan to do in 2025, can you get back to this broad rally then? Does the Fed feel confident in the economic trajectory then? Because I think it's also the economic story that's playing a big part of it, right? That's a big part of the 493, is it's a call that the US economy will continue to do well in 2025 and that rates will hopefully come down a little bit. And I think you're just seeing some uncertainty, and when we've seen uncertainty in the last year and a half and a little bit of uneasiness about where macro is going to go, people hide in the Mag 7.
Yeah, you see that concentration. All right, Josh, great stuff. Thanks. Well, the AI fervor fueling a post-earnings rally for chipmaker Broadcom, the company predicting booming demand for its chips over the next few years. CEO also saying that Broadcom had won 2 major new hyperscaler customers, the biggest operators of data centers. Joining us now to discuss this, we want to bring in Stacey Raskin. He is Bernstein's managing director and senior analyst. Stacey, it's great to have you. It looks like a blowout quarter here for Broadcom. AI revenue for the year more than tripling. What is your biggest takeaway from this print?
Yeah, so I think there were 3 things here, and you have to keep in mind, people were very nervous going into this print, especially around the guide. People were broadly expecting a miss. The quarter itself was fine. The guidance was actually in line. They didn't miss. It was mostly on software rather than semis, but I think that was okay, given where sentiment was. So that was number one. That the guidance was okay. And the AI semis, which is what everybody really cares about, they were pretty strong. They also painted a really good picture, secondly, like into the back half as they have new AI products ramp, and it actually does look like the AI trajectory through the year like gets a lot better, and I think better than even where people were modeling it. And then thirdly, over the longer term, they really gave people a reason to dream, right? So they were talking about, over the next, say, 3 or 4 years, they have 3 primary hyperscaler customers today that they sell AI chips to. And they pointed like sort of visions of a very large opportunity. They said sort of $60 to $90 billion potential opportunity over that time frame just with those 3 guys. And they, as you mentioned, they talked about 2 new potential customers. They haven't actually won them as customers yet. They're sampling, they're engaged. There's no volume yet, but they sort of painted this optimistic picture that the 3 customers that they're with driving that revenue, that's not the end all be all of it. There's potentially more as we go through it. And all of this, I mean, you start to think about what that AI trajectory looks like versus where numbers were, especially in the out year, and you can start to dream some really nice things in terms of where the earnings power of this company could go, coupled with what, like I said, what I think was very nervous sentiment going into the print. I'm not actually surprised that it's running up as strongly as it is this morning.
And so looking at the run up here, pre-market up 18%. A lot of investors going to probably be looking at a new all-time high for Broadcom shares at the start of today's trading session. Is it too much to dream for more from this point? Should you be chasing the stock at this level?
Well, I don't think it's too much to dream. Again, you can start to work through some of the numbers of where the earnings power could be. And you think about even where Broadcom is trading versus like some of the other AI names. People sometimes complain about Broadcom's valuation because it is certainly more expensive versus its own history. That being said, it is a totally different company. You go back 5 or 6 years, like 40 or 45% of their business was wireless. Today, it's all AI and software, like much higher growth, much higher margins. And if you look at Broadcom versus other quote unquote AI names, it's actually one of the cheaper ways, if not the cheapest way to play AI. So no, like I'm not surprised that it's running, and I think the general perception is you probably have to be there, that this can work. And by the way, especially through this year, because like I said, they kind of set the numbers where they are in the first half. I think you got line of sight to like really good growth, especially onto AI into the second half as some of these newer products ramp. So I think there's going to be a view that things are safer to own now, and with that longer term story, I think people are going to want to be there.
Stacey, what are the implications here for NVIDIA when you take a look at the stock's reaction here this morning, up just a little bit here in the pre-market? On one hand, I think you could argue this is good news here, just really speaking to the demand that we've heard from NVIDIA. But on the flip side, maybe you could look at these results and what we're hearing, the narrative from Broadcom, and really that shows that some of these tech giants are doing everything they can to strengthen their in-house chips.
Yes and no. So they are doing everything they can to strengthen their in-house chips. And that's not new, by the way. Like Broadcom sells to Google, for example. They've been selling custom chips like this to Google for 10 years. Like it hasn't slowed anything down, right? I tend to lean more on the former of those two. Yeah, you can argue, hey, maybe it's a negative because there's more competition. My view is if it is really true that all of these hyperscalers are going to be spending that kind of money over that period of time, I think it's actually good for everybody that's selling into that space. Like one of the bigger worries that people have for NVIDIA is just the numbers have gotten so big so quickly, you just worry about sustainability. It's fairly clear that at least Broadcom doesn't see any issues with sustainability of those spending trends in general. And if that is the case, I suspect that a rising tide will lift all of the boats here. I think it's actually bullish for everybody who's successfully selling into this space.
So how much focus and emphasis does that place on what they were talking about on the call yesterday with this serviceable addressable market for Broadcom and the baseline that investors would look to see kind of set in after a longer period of time?
Yeah. So they're serviceable. They talked about a 60 to 90 billion SAM, serviceable addressable market, for these three customers. So 20 to 30 billion dollars a piece. For Broadcom, that is only at those three customers. So they're not looking at anything outside of those customers. That SAM includes their what they call XPUs, their custom AI ASICs. It also includes GPUs at those customers, not GPUs more broadly, and it includes networking. So that's kind of what they're looking for. So it's I got to be honest, it's not exactly a clean definition. It's not exactly how I would define SAM, but fine. I do think it is a measured view. Like I said, they're not looking broader than where the areas that they're currently playing already. And I think they gave like line of sight to potential upside, at least to potential broadening of that SAM across to other customers. And if that happens, I think you'd have more potential opportunity for them to go after.
Yeah, that drew a couple questions from analysts on the call. So I knew I had to get your take on it as well. Stacey, thanks so much for taking the time here this morning.
You bet.
Well, with Broadcom set for its biggest gain since 2020 at the open, what can we expect from the overall tech sector in 2025? Joining us now with more, we've got Peter Chur, who is the Academy Securities head of macro strategy. Peter, great to have you here in studio with us.
Awesome to be here.
So what are your expectations given the run-up that we've seen, not just in Mag 7 names, but more broadly within tech and the leadership that's carried over the course of this year?
You know, I think it might be getting carried away with itself a little bit. I'm not going to touch it right now. I think it can continue to go into December, early January. But I do think the friction with China is going to be impacting these businesses, right? Trump is not going to bend over easily on China. He's going to fight with them. It's going to be very oriented around chips, AI, so I think that's a risk. And I think there's been a lot of excitement that we're really going to see a lot of M&A activity and growth. And I'm not sure, I think it's going to be much better than it's been under the Biden administration, but I'm not sure he's going to, let deals happen that much easier.
So then is the market getting a little bit too complacent with the Trump trade? And I guess what does that signal just in terms of maybe some of the risk that investors are overlooking?
Yeah, and it's kind of funny because about a month ago I felt I was trying to talk people off the ledge. Trump's not that bad. A lot of these are just bargaining points. And now everyone seems so comfortable and calm about everything he says. And my experience with him, and I think probably all our experiences, when it gets calm, he likes to up the ante. So I would expect a little bit more noise coming from him. I would say this, it surprised me that he invited Xi to the inauguration. Maybe he's going to try and play nicer with China, but I still suspect ultimately we're going to see a lot of chaos. He likes that. That's how he operates. So the market's become overly complacent right now.
I think the markets are also trying to figure out what a net win looks like even after any tough talks against China or with some of our neighboring countries as well here with Mexico and Canada. What is the net benefit that the markets would ultimately price in? And then if we did not get that, what's the other downside of that?
And I think the hope is that what you see is a well-targeted tariffs on things while maybe providing some subsidies to grow U.S. businesses so that 2 or 3 years down the road, we are producing a lot more domestically. We're seeing that growth. I think that's a lot to ask for, right? You kind of need both. I think tariffs alone without subsidies aren't going to get there, and the subsidies have to be well placed. Just look at the CHIPS Act. It's taken so long to get that money out to companies. So I think we're all a little bit optimistic, like, oh, we're going to turn this on a dime. We're going to have manufacturing here. It takes time. It takes years. So there are going to be stumbling blocks that are hit, and everyone's just a little bit too, oh, this will happen quickly. I don't think it does.
How do you see it influencing, I guess more broadly speaking, just market dynamics?
I think we're going to have to get used to noise, right? There's going to be, everything seems clear sailing. Next day, something else comes out that changes that around. So I think he's going to watch that. And I think we really have to watch Europe in particular, because I think Europe's quite weak. And for the first time we're having trouble with Europe, it's led by Germany. Germany itself is having problems. So they could be a big drag on the global economy.
It used to be that we were starting off these conversations talking about the Fed. We're not doing that right now. Is that more of an indication of where the prioritization from the markets are, where the Fed sits within that prioritization?
Right. I think the Fed's kind of hit this point. They'll cut this week, or sorry, next week for sure. But after that, I think they're going to go on hold a little bit. I think you've got jobs are okay. We had a uptick in the unemployment rate, but that's really because we had 2 weak household surveys in a row. That tends to correlate back. So I think you're going to have okay employment, and inflation's been sticky. And the other thing, you're going to start seeing inflation data. Companies have been ramping up, purchases of chips and everything else ahead of potential tariffs. So I think you're going to see inflation spike up a little bit coming into January, February. That puts the Fed on hold, and everything's going to be, do we get this growth? Is AI story really there? And how do we play it forward?
Yeah, Peter, that is the big question. And we've been talking to so many strategists, analysts here over the last several weeks, obviously. And a lot of the focus has been on some of the outperformance that we could see in 2025. When we talk about Fed narrative, obviously it's changed a little bit, especially in recent days. But there has been so much optimism surrounding financials specifically, and a lot of that on the back of the expected rate cuts. Does that at all then change the narrative or the bullish outlook that we have been getting for the sector?
Yeah, and I think what I'm looking for right now is really, I like anything that's involved in the commodity industry. I think commodity prices will remain low, but I think Trump is going to go through very closely all the rules and regulations we put in the last 10 to 20 years when we are the sole superpower and say, do these make sense? So I think we're going to see a lot more extraction of rare earths, critical minerals, and energy domestically, but also more and more refining, right? We have not built a new refinery in this country since the 70s. We've updated them and stuff. I think there's going to be a real push that we have to be able to process and refine these rare earths, critical minerals to remain independent. So you're going to see the companies like the CATs, John Deere, all those, anything involved in infrastructure building, refining, do very well. So that's my favorite sector to play right now, because I don't think it's fully priced in at all.
We've heard some lofty expectations for next year, S&P 500 targets ranging from up 10% to up 15%. All these things considered, what do you think is realistic, and are there growing pains to get to that number?
I think the risk is if Europe starts turning itself around and get something, the valuations there are just so much cheaper that you might see money out. Right now, everyone seems to believe the U.S. is the best game in town. Everyone wants to be shifting into the U.S., and there's only so many stocks, so it is going to chase that higher. So I think something has to change in the global narrative, where some other part of the world you start saying, actually, that looks so cheap, and it looks like that's where the growth story. So I think that's the big risk to the U.S. markets, is something turning. So far, it doesn't look like it's happening. Trump's being much more aggressive, proactive, and rate cuts aren't going to cut it in Europe. They need fiscal stimulus.
All right, Peter Char, always great to have you. Thanks so much.
Thanks for having me.
Coming up on Morning Brief, we're going to count you down to the opening bell on Wall Street amid the rally that we've seen in tech. Plus, we dig into numbers from retailer RH as the company sees strong demand ahead. And Costco getting a boost from e-commerce and higher annual fees in its fiscal first quarter. We're going to break it all down with an analyst. That's coming up later on this hour. You're watching the Morning Brief. Now time for some of today's trending tickers. You can scan the QR code below to track the best and the worst performing stocks of the session. It's all done with Yahoo Finance's trending tickers page. First up, let's take a look at RH, previously Restoration Hardware, raising its full-year revenue outlook on strong demand. This coming despite earnings estimates for the third quarter earnings estimates. The luxury home furnishing company saying that it expects fourth quarter revenue to increase 18 to 20% from a year earlier, and that is really what has the street excited. You're looking at shares rising just about 15% here ahead of the open. Strong consumer dynamics is what is being called out here in this print, and this always colorful letter that we get to go along with the earnings releases each quarter. What was interesting, what stuck out to me, Brad, was some of the analyst commentary that we are getting this morning, and one from Baird. Baird's analyst Peter Benedict just calling out, he's saying the prolific product transformation is something that customers are really starting to respond to. He sees that really driving and building on some of that momentum that we have seen. The fact that the guidance here exceeded expectations, margin outlook also encouraging. That was enough for him to raise his price target by $100 to $400 a share. So still slightly below where it's slated to open today. But again, this might have come as a bit of a head scratcher here to others on the street, just given the fact that some consumers are holding back on some of those larger ticket items, but you're seeing RH, and it's very pricey, to say the least, outperform in this environment.
I mean, well, their consumers aren't pulling back right now. The luxury and the more affluent end of the market, but for luxury and affluence that are holding up some of the consumer spending right now and really factoring in more weighting to that resiliency part of the equation more broadly that we've been hearing, perhaps they're saving a little bit more by going to Walmart and saying, you know what, we can still go to Restoration Hardware for certain items. But for investors here this morning, you're going to be looking at Restoration Hardware opening essentially at a 52-week high. And the outlook here is really what is being factored in, I think, as well to this move here. Q4 total demand growth 20 to 22%, revenue growth of 18 to 20%. They raised their fourth quarter and full year guidance as well, and full year total demand growth of 9.9% to 10.4%, and then a new range for revenue growth as well, with the midpoint at about 7% there.
Yeah, I mean, it's been just taking a look at the year-to-date chart. I mean, this is a stock that hadn't done much for the first 9 months of the year, and now we're seeing a bit of a resurgence here. And I think a lot of that has to do with the product pipeline that Baird was mentioning within the note. That's really helping to reignite some of the sales that had been a bit lackluster this year.
Yeah. We're also watching shares of Tesla today after it surged to a record this week. Meanwhile, Elon Musk is reigniting his feud with the SEC, writing on social media that the commission has issued a settlements demand following the probe into his buyout of Twitter. The regulator has been investigating whether Musk committed securities fraud in 2022 as he sold shares in Tesla and shored up a stake in the social media company Twitter. Yahoo Finance's Rick Newman joins us now on this. Rick, just want to get your read in on the situation here.
Well, I think if you asked Elon Musk, he'd say it's the SEC that is pursuing its feud with him rather than the other way around. Not entirely clear what's going on here, but the SEC seems to think that Musk did something approaching securities fraud with the way he sold some shares of Tesla, where he's CEO and he owns a bunch of shares back in 22 while he was building a stake in Twitter, which he ultimately bought, of course. And there have been some civil lawsuits over this that perhaps prior shareholders in Twitter got shortchanged somehow. So the SEC, and we only know this because Musk published this letter, or he made it public, but he didn't publish all of it. So the SEC wants Musk to pay fines, or else they say they're going to go after him. However, as we all know, Gary Gensler, the current SEC chair, is stepping down. He's going to be replaced by somebody Donald Trump is going to appoint, and Elon Musk, who is sort of like the unelected vice president, is sort of laughing this all off because Trump is going to take over and the SEC is going to throw this out. So it's going to amount to nothing. So that's why Elon Musk has seems to have a rather droll attitude about it, trolling Gary Gensler on Twitter.
Rick, is he too quick to dismiss any of those concerns?
Well, this is how Elon Musk plays this. I mean, even back when the most serious allegations of Musk were that he committed securities fraud back in, I think it was 2018. When he made that tweet about taking Tesla private at $420 a share when there was no deal whatsoever to take Tesla private. He got fined for that, and he pouted and stomped his feet and said, the SEC is being so unfair to me, whereas by most objective standards, that is blatant securities fraud. To say you're going to get a deal at a certain, I mean, you mentioned the stock price and you are the CEO and you're the largest shareholder in the company and you say something that's clearly false, as we learned later. So he's had a beef with the SEC ever since then, as if Elon Musk doesn't have to play by the rules that all the other public shareholders have to play by. He got a wrist slap basically in that case. And this is coming way late in the Biden term, and nothing's going to happen. So this is Elon Musk 3.0, if you will, the Trump whisperer.
And we have much more to hear from that over the coming months and years. All right, Rick, thanks so much.
Bye, guys.
Coming up, we are bringing you the opening bell on Wall Street when Morning Brief returns. We've got the opening bell coming up on Wall Street as we kick off the final trading day of the week. You got Tin Can ringing the opening bell down at the New York Stock Exchange, and you have a C.H. Robinson ringing the bell from the Nasdaq, the logistics company there, as we kick off the final trading day of the week. We're looking to reverse some of that downward pressure that we have seen a little bit more broadly speaking when you take a look at the Dow coming off its longest losing streak that we have seen since April, I believe. So here we are at the open. We're seeing a bit of a mixed open here. I believe you have the Dow just holding on to gains up just about 0.1%. You do have the S&P trading to the upside here as it calibrates here. Takes just about a second. We're a little bit delayed. Let's take a look at the S&P up just about 0.3%. We're going to wait for the Nasdaq to calibrate there. Taking a look at the Russell 2000, we talk about so much of the concentration, the gains really being led by only a handful of stocks here, at least over the last several trading days. As a result, you've got the Russell 2000 under pressure once again here as we wait for that to open. Taking a look at the bond market, the 10-year yield moving up just slightly, now above right around 4.35. So again, a critical level here to watch. When we flip over to the intraday action, the sector action that we are seeing, you got tech, the leader here today, followed by financials and utilities. Taking a look at that 5-day look, though, and we are seeing a bit of a mixed picture, a lot more red on the screen clearly than green. You've got communication services up just about 1%, consumer discretionary among the outperformers. On the flip side, you got healthcare. Those stocks remain under pressure. That has been the case now for just about a week and a half. XLV off just about 2.5%. You're also seeing some pressure from materials. But let's take a look inside the Nasdaq, and we have the 5-day look here that will be pulled up in just a minute. But you talk about the outperformance from so many of these larger cap tech companies, the Mag 7 specifically. We got the record high earlier this week from Tesla. We've seen a number of these Mag 7 names reach new highs. The 5-day gains for some of these, at Google, you have up 10%. You have lots of excitement surrounding the quantum computing Willow chip there and what exactly that could signal here going forward. You also have Microsoft up just about 1%. Apple, another outperformer, up just about 2%. Let's kick it over to Jared Blickery for a closer look at some of the movement that we're seeing. Jared.
Thank you, Shauna. Yeah, I think you're absolutely right about those larger stocks, the mega caps, Mag 7. They have been dominating in the month of December, and that's a marked change from what we saw after the election when it was the small caps that were dominating. And let's take a look at the Dow. This is something interesting here. Dow has been down 6 days in a row, so it looks like it would snap that streak if it closes in the green. It's up a whopping 23 points right now. But all these indices, even the ones who have fallen off a little bit, are still pretty close to their record highs, and I think we need to take that with a grain of salt. We have seen the rally narrow once again, so you don't have as many components in the S&P 500 that are going up every day as down. In fact, that has been the case for about 9 straight days. That is something that does not happen very often, and it's something that we should pay attention to. But I would say at this point, because it is December, it's just a yellow warning flag. All right, this is, I'm not trying to get to crude, I'm trying to get to the 10-year T-note yield. Here we have that up 3 basis points, and as you can see on this 3-month chart, we have a little bit of a rally underway. Doesn't make much of a difference until we get over 4.5%, but that's something we also want to keep an eye on. US dollar index in a similar boat there. That's the euro. Here's the US dollar index, pretty close to its highs as well. Let's get to the sector action. And I think we were just looking at the 5-day totals for some of these. And just to recap, tech is leading today. Utilities is also outperforming. Those are the only two. And now it is staples that is lagging. It was communication services earlier. But on this 5-day total, it is some of those mega cap sectors that are the outperformers here. You're going to see that with XLY and XLC. And then tech, even though it's in the red and underperforming here, that is also close to the top. I wanted to take a look at the chip sector. Broadcom really juicing things. This is a 5-day look. I'm going to dial this back down to a 1-day look intraday. And here we go. Broadcom up 20%. Let's just put a max chart, and you can see how it has just gone parabolic over the last few years. So an important chip company right there. And China, let's take a look at China. This has been another volatile week. You can see a lot of red on the screen. Watch what happens when we put the 5-day total. That's going to shift a bit, and you can see a lot more green than red with a few exceptions there, just to underscore that China remains a very volatile place as they try to reflate their economy. It has come in fits and starts, and I think that's an understatement. Want to close on the commodities here where we have gold and silver. Those are falling off, and in fact, this is a 2-day slump. Let's start with silver, and here are the 2 days that we're talking about. Not a huge movement. You can see over 3 days might look a little bit more pronounced. There we go, down about 5%. Here is the year-to-date chart for silver, and you can see, is this looking like a top? Too hard to tell. This just might be a false break to the upside right there, technically speaking. And a pretty similar situation for gold, which is down 1% today. This is the year to date, and it is simply consolidating near recent highs. Send it back to you guys.
All right, Jared, thanks so much. Kicking off today's trading activity. It's time now for our chart of the day. Let's send it on over to Catalyst co-host Madison Mills for a look at market breadth. Maddie?
That's right. We are seeing bad breath for the market here. I want to take a look at the S&P 500 equal weight compared with the market cap weighted S&P 500. You can see this big divergence between the two that has really widened since we started off the rally following the election in early November here. And it's the longest streak we've had of more stocks going down than up since the 9/11 terror attacks. What makes this particularly interesting, though, it is that this is the first time in U.S. history where we've had this bad of breadth while still having a market rally. That has never happened, and we are seeing it happening right now. Interestingly, the last time we saw the same degree of bad breadth in the market, it was 2018. That was when the market bottomed in December, and we were dealing with what back then? Questions about Trump's tariff policies under Trump 1.0. So interesting to see we're in a similar dynamic as we do await clarity on those policies. Having said that, this is a moment in time, right? As Jared was mentioning, we've only been seeing this bad breadth play out over the last 2 trading weeks. It hasn't been months or even years of that bad volatility. And Chris Veroni this morning adding that 70 to 85% of stocks have been within their 200-day moving average all year this year. So we haven't seen this lack of a rally across the board consistently. So this could be something that is a little bit more idiosyncratic, maybe taking some off the top before we get into that end of year Santa rally, as it's called. The bigger question, though, can the market live up to all of the hype that we've continued to report on heading into 2025 around those bullish price targets? Of course, we've got the Fed cutting, we've got policy like corporate tax cuts as well, and we've got earnings to look forward to. Any one of those three, though, if we kind of take a step back from any of those and have a little bit of a challenge in them, that could present an even more kind of challenging environment for stocks, as we do have such high expectations heading into 2025. Guys.
All right, Maddie, thanks so much. Appreciate it. Time now for today's strategy session. Overall market breadth is worsening here, and the trend is also hitting tech stocks. The Nasdaq 100 has risen over 3% so far during the month of December. However, the equal weight Nasdaq 100 is up less than 1% for the same period. Joining us now, we've got Aaron Brown, a portfolio manager over at PIMCO. Aaron, great to have you here on the program with us this morning. So just starting with that, why do you think we're kind of seeing this dynamic play out?
There's a real dichotomy between the haves and the have-nots in the tech sector right now. What you're seeing is that those tech companies that are really leveraged to the AI theme continue to do quite well, whereas those semiconductor chip companies that maybe are more geared towards the old economy, to the autos, to more of the analog and industrial sectors of the economy, have really underperformed relative to, the very advanced chip node AI companies. And so this dichotomy has played out throughout the entire year. It continues to play out. What's been interesting is as we've moved through third quarter earnings season, we've heard more of the same from many of the chip companies, which is everything related to AI is doing extremely well. On the other hand, the industrial cycle continues to be a laggard. And if anything, it's actually been pushed out. Whereas many of the chip companies coming into the beginning of the year expected the auto sector to turn, the industrial sector to turn, in the second half of 2024. Now it's been pushed out to the second half of 2025. And so we're really continuing to see more of the same play out. And all of the money is just flowing into everything AI related. And that's why this dichotomy has emerged that you bring up.
So Aaron, what do you think that upside then looks like for these handful of stocks that have been leading the rally now for so long?
So I think what you continue to see is quarter after quarter, you've seen positive revisions to the AI sector, and they continue to see more growth ahead, more demand than they're even able to meet. And their constraint is on the supply side, not on the demand side. So I think that this is really a secular trend that's going to continue, at least for the foreseeable future, the cyclical horizon. And I think 2026 is going to be 2025 is going to be another good year for the AI levered names. You've started to now see some of the leadership switch just from the semiconductor chip companies to more of the software developers, the enablers for AI. And so as an investor, we're starting to look more at some of the software companies, not just the chip companies, which are trading at very high multiples, certainly can leave them, room for some disappointment. But I would be buyers of any weakness that you see in some of these AI chip companies, but also start to turn my attention to some of the software enablers.
We've seen a massive post-election rally here, and that's certainly playing into where we've seen the valuations get stretched here and where the sentiment has really prevailed among the markets and investors as of right now. I wonder what your net assessment of the post-election implications for the market are, especially as there are people, cabinet positions that are starting to really get some clarity around them, and the markets are at least cheering on less regulation and the thought of that.
So I think that you have two sides of the market. On the one hand, you have the potential for continued low corporate tax rates, as well as the potential for deregulation, which could be really meaningful to companies' bottom lines. On the other hand, you have this uncertainty with tariff policy, and ultimately, the cost that companies are going to have to bear in the form likely of lower margins if some of the more punitive tariff policies are put in place. And so I think it becomes very much a stock picker's market in this environment, where you're going to have more dispersion across companies between those that are more insulated from tariff policy and are just going to reap the benefits of lower regulation versus those that are going to be more exposed to tariff policy. In aggregate, we're still going to have, I think, a fairly decent year next year for stocks. It might be a little bit volatile, particularly as some of these tariff policies are put in place. But we're still in an environment where, coming out of the fourth quarter, the U.S. consumer is doing exceptionally well. We've seen strength build into the fourth quarter. There was a period of weakness over the summer for the U.S. consumer. That's now been ameliorated, and we're seeing actually strength build into the fourth quarter. Consumption growth has been strong. U.S. GDP growth has been strong, and inflation is still, somewhat muted. It's potentially bottomed, in the very short run, but we still expect that it's going to continue to fall next year. So you're coming off a period of strength. I think that the equity market's going to do well next year, but I would be really specific about staying away from anything that's really exposed to tariff-related concerns.
All right, Aaron Brown, thanks so much. Coming up, Costco seeing some steady demand despite raising its membership fees. We're going to break down those numbers. That's coming up next on Morning Brief. Now, as we head to break, let's take a look at Broadcom. You're looking at a jump of just about 20%. The stock seeing its biggest intraday gain in 4 years. This coming following its blowout results. Also, the guidance that the company gave, very much stoking some of the excitement surrounding AI, what exactly that demand is going to look like heading in to the new year. We're also seeing some of its competitors rise as a result of that guidance. We got much more coming up on Morning Brief. Costco beating earnings estimates for its fiscal first quarter after increasing its membership fees. E-commerce, also a big driver for the retailer this quarter, was up 13% from just a year ago. Corey Tarlow, he is Jefferies' Senior Vice President of Equity Research, joining us now on this. And Corey, when you take a look at the stock's reaction versus what we're hearing from Costco, a little bit of an inconsistency. I'm curious how what your read is on these results and maybe how that sets up Costco in this new year.
Yeah, good morning, and thank you for having me. I think the results speak for themselves. 40 years of really consistent results, and this quarter was just yet another proof point of two really key metrics that I think are key to highlight here. One is market share, and the other is margins. On market share, their comps were up 5% roughly worldwide and in the US. Most other retailers are not posting 5% comps, and almost all of that is driven by traffic. So membership is really at the core of what they're doing here, and it's all driven by traffic. And this is helping to really improve unit economics and overall flow through to the bottom line, which brings me to my second point on margins. The first quarter was the highest operating margin that Costco posted in roughly 2 decades. So what you're seeing is a flywheel of a business that's driven by membership, but then given the strength in the membership trends, they now have the ability to invest in price and wages while still driving flow through to the bottom line and rewarding shareholders.
Corey, from your assessment, what's the stickiness factor among some of their wealthiest consumers, the more affluent consumers that are signing up for Costco memberships, trying to get gold bars, and maybe purchasing some Kirkland irons?
Sure. Well, they've seen very good results from gold and jewelry, up double digits in the quarter. And their general merchandise business was actually up high single digits. Most other retailers are seeing lackluster results for general merchandise. They're actually negative. There's one other retailer that's been positive in the last quarter at mass, and that's Walmart. And it was up low single digits for the first time in 11 quarters of being down. So you're seeing really, really strong results from Costco in a general merchandise category, which I think speaks to their ability to curate amazing items. And it's a credit to Costco's merchants that really resonate with their customer that is a bit higher income. And a lot of these members, they have 77 million members now as of the last quarter, are actually executive members who over the next year, given Costco's raising their membership fee, are going to be paying not $120, but $130 because they raised the membership fee recently.
Are they going to be able to continue to expand their footprint, do you think, just given the macroeconomic environment right now?
They're opening clubs at the fastest rate on a nominal basis than they've ever done. Costco's opening, call it 25 to 30 units a year, and most of those are actually indexing to the US. And historically, if you go back, they had always said that they wanted to open more internationally, but there's just so much fill-in opportunity in existing markets in the US that they're going to continue to open more units in the US than they are internationally. Now, the goal is to ultimately index 50-50, but right now it's much more US. And I'll give you one example. They just recently opened a new unit in Pleasanton, California. They did this the day before Thanksgiving. The unit opened the first day at $2.9 million. That's the highest single day of sales for a new unit ever in Costco's history.
Corey, is Costco the best wholesale buy in the market right now, or is there another right now that's out there in your mind?
Look, I mean, I think Costco's within the club retail channel, without a doubt, the best performing stock. And it's likely to continue its momentum as we look ahead. Every single metric up and down the P&L speaks to a positive bias. You have upside from membership fee, you have upside from comp and traffic, and then again, the continued flywheel given the investments in price and wages, yet still expanding profitability. So we do really like Costco. Pushback from bears has been valuations a bit rich. However, if you tie those valuations to fundamentals, what we've looked at is that the EBIT per square foot or operating profit per square foot actually ties directly to fundamentals and continues to point up and to the right. So there actually is further upside, not only to numbers here, but also valuation.
Corey, real quick before we let you go, there was one thing that you pointed out in your note that you didn't really like from this quarter, and that was the fact that renewal rates here for membership did slightly dip here during the quarter. Why isn't that a bigger concern to you?
So this is driven by more members that joined online. And there is a bit of a caveat. So the renewal rate was about 90.5% last fiscal year. It dipped 10 basis points, very modest, to 90.4. It was driven by more online signups. Those online signups tend to have a little bit lower retention rate. However, the core of the business, which accounts for most of their members, is very, very healthy. So no real underlying concern here, but it is something to be aware of. And Costco had pointed out that this may be a headwind to renewal rates for this fiscal year.
All right, Corey, we got to leave it there. I got to go pick up some pesto butter salmon real quick. I'll be back. Thanks so much for taking the time here.
Thank you.
Coming up, everyone, a look at the analyst calls that are moving the stocks this morning. Stay tuned. You're watching Morning Brief. We're taking a closer look at some stocks moving on the back of analyst calls, and we're doing it in 30 seconds apiece. Let's go. First up, we got a little Uber named a top pick for 2025 at Goldman Sachs. Analyst Eric Sheridan sees more than 50% upside from the Thursday close, citing stocks with more compelling risk to reward balance, and he's optimistic that Uber can deliver on its goals and grow, citing a key theme around advertising and e-commerce working more closely together to Uber's benefit.
Plus, Apple named a top pick for 2025 at Morgan Stanley. The analyst citing AI as a driver of an iPhone upgrade cycle. The rollout of Apple Intelligence, double-digit services growth, and expanding gross margins are among those catalysts that they see pushing Apple's stock higher. The analyst reiterating an overweight rating on the stock, $273 price target.
Every time you read upgrade cycle, I glance down at my cracked screen. Finally, D.R. Horton, Toll Brothers, and Meritage Homes all downgraded at J.P. Morgan. The analyst taking a more cautious stance on U.S. home builders in 2025, seeing a less supportive demand-supply backdrop. Now, he expects fundamentals to see margin and return on equity contraction next year. Shares of all these companies here on the day, they are trading lower.
Well, that does it for Morning Brief. Keep right here on Yahoo Finance. My co-host Madison Mills will be joining me for the next hour. We've got much more analysis coming up on Catalysts. Welcome to Catalyst. I'm Shauna Smith alongside Madison Mills. We are 30 minutes into the U.S. trading day. Let's take a look at the three catalysts that we're watching this hour.
First up, we'll bring you investor expectations for 2025 as inflation and higher rates loom over markets.
Plus, Alphabet shares hitting a record on quantum computing breakthrough. We're going to break down how to trade the quantum computing sector.
And as Warner Brothers announces a new corporate structure, we'll break down how to play strategic opportunities in media. Stocks are looking mixed this morning as investors await the next Fed meeting and as they digest mixed read on inflation data this week following CPI and PPI data. Now, it's interesting, Sean, I took a look at the market activity that we've seen since the Fed's last hike in July of 2023. The S&P is up over 33%. That is well above the gains that we've seen in prior Fed easing cycles. So what is it about this particular moment? Is it the earnings picture? Is it incoming policy projections? Or is it simply betting on Fed easing? And if it is that, what do any concerns on inflation mean for the market heading into 2025?
Yeah, I think you're exactly right there, Maddie. And I think we certainly have seen a bit of a recalibration or changing of the narrative that you and I have talked about time and time again over the last several trading days, to say the least. But I think you can go back even further and see the last few months and some of the concentration build in the market, some of the expectations we talk about. Not so much the threat of policies, but I would say the threat of tariffs, some of the policy implications maybe that we could see into 2025, that how that's shaping the narrative going forward. I think when you take a step back, though, you take a look at some of the results, even out this morning, when you take a look at a name like RH, really showing the fact that some consumers, especially the higher income consumers, are still out there spending. And that has been something that has continued to surprise people, I think, relative to those expectations going into the start of the year, rolling back the clock about 12 months ago. And I think that's adding to some of that uncertainty as you look ahead to 2025. When you take a look at so many of these outlooks that we're getting for next year, we're going to be talking a little bit more about that in just a minute. But so much of that falls back on the strength of the economy and the resilience there. And the importance of that is really just driving some of that momentum that we could see here in the new year. Just how inflation plays into that is the biggest question, or is one of the biggest questions, I should say, at this point.
And to your point, the mixed picture when it comes to the market's reaction to earnings. Yeah. You've got a name like Broadcom soaring to the upside, then Adobe, a huge disappointment. It feels like it's a very make or break moment for individual names.
It does, certainly. And I think we've also just seen that in the market breadth, too. I mean, it's obviously like the obvious call there would be the Mag 7 and some of the concentration there. But even beyond that, it clearly has been a stock picker's market, it seems like, at least in just in terms of some of the winners and losers, especially when it comes to the AI trade. All right, well, the Fed's progress on inflation is set to stall potentially in 2025. That's according to Robinhood's outlook for next year. Let's talk about how to play it, the market implications for that. I want to bring in Stephanie Gill, Robinhood's head of investment strategy. So, Stephanie, walk us through what ultimately this means, the broad picture here for the equity market next year.
So I think, yes, inflation will probably, the progress of it will likely stall. So I'm sort of expecting it's 2.6 now, maybe it's 2.3% at the end of the year. I do think this past print was very positive for the markets in the fact that shelter showed a little bit of an improvement, and that's been the stickiest part of it. And then transportation too had no change in price, month over month. So that's a good thing. But I think that means yields will stay elevated. And that means mortgage rates will probably stay elevated, credit card rates will probably stay elevated. And it actually keeps a lot of the market, I think, in check. And that's what I think is a positive. Like if you have super low rates, it means that there is not much risk to borrowing. And it means that the return that you might put that money in doesn't have to be that high. And so I think it actually keeps a good economy going better if rates are sort of a little bit elevated.
What does that mean then in terms of household allocation to the market? Because we know that that's already at a record high, and then you mentioned there's still going to be these kind of headwinds to the individual economy with things like housing prices and on those mortgage rates, for example. What will that mean for markets moving forward in terms of just any cash on the sidelines that retail investors still have?
I think it means that, cash will still earn a yield. And so that means that maybe there isn't always a rush, right? Like you can still keep money on the side and have a decent return on it. But I also think that it means that there are still going to be opportunities. Like, as you said earlier, this is a stock picker's market. And I've been thinking that for a while. You just look at something like today, Adobe had not a great, report. I think it starts being like, oh, what's happening in tech? And then you have Broadcom today that looks really good. And then you have RH, which is also very strong. And they couldn't be two different types of companies. And you're seeing like the intra-stock correlations. During the period where we had super low interest rates, intra-stock correlations were relatively high. They could reach as high as 0.5. What I mean by that is any particular stock would just sort of move with the market. And you're seeing less and less of that. Now it's really down to company management decisions, the businesses that they're in. You know, AI is obviously a huge theme that will continue. But I just think it means that there's lots of opportunities under the surface, and just buying a large cap index, I think, is going to leave money on the table.
Stephanie, when you take a look at the concentration or the lack of breadth, more broadly speaking, in the market, especially what we have seen just this month alone, how is that then? Is that introducing maybe more risk into some of these calls, or even into your outlook looking ahead to next year? Just talking about the fact that maybe it's going to take a little bit longer for some of that broadening to happen.
Maybe it does. I think it will just come in waves. Like, you know, small caps rallied a ton after the election. Now you've seen a little bit of a pullback, and you're having the largest tech names doing better. I think it will just sort of, you know, go as earnings come out, as news comes out. But it is really very much like, I think, you know, I put this in my outlook, but Peter Lynch famously said, like, the person that turns over the most rocks wins. And I think that's the kind of market we're in, just kind of doing the work and looking at fundamentals of a company, and not necessarily saying, like, what do I think rates are going to do and what do I think the broad market is going to do? Mm-hmm. But yes, I do think that it means that typically there's a little more risk. Like, if small caps rally, they tend to have more debt on average.
What does that mean for your call on mid caps?
I like mid caps a lot because they're less expensive than large caps. You know, they're trading long-term average, they're about 3 times below what they tend to trade of 2026 earnings expectations. But they tend to be just a little more stable than small cap names. They tend to have a little more breadth in terms of the sectors, whereas small caps tend to be like financials and industrials. You really have to believe in our economy growing very strongly relative to other economies. And if you have tariffs coming in, that might disrupt that a bit. So I just think mid caps are in the sweet spot. Like, I call them the middle child that get ignored, but it could be, I think, a good place to have money.
Stephanie, as we look ahead, and this is a little bit more short-term thinking, but you look ahead to the Fed meeting next week and some of the commentary that we're going to get, the dot-plot projections in terms of the path forward here for policy. How much of that has already been baked into the current prices here for the market? And I guess how big of a factor do you see that being relative to the Fed conversation and the driving factor that was in terms of the narrative that we've heard this past year?
Yeah, I don't think it's going to be as much. That's why I think, like, it's expected that they'll cut next week, especially because of after the CPI and just sort of showing a little bit cooling under the hood. So I think that eventually it will stop being such an issue, because I do think they're going to stop cutting by the time they get to around 4%. I think, you know, consensus is 3.75, so we're not that far off. Mm-hmm. But I just think growth is going to be strong enough, and the labor market is not going to be soft enough for them to cut further than that. And so then I think it becomes a non-part of the conversation.
Is any potential dip, short-term or longer-term, that may come off of that a viable one?
I think so. Yeah, I mean, we've had such a strong market, and I think that could continue into year end. I wouldn't be that surprised if we had a little bit of a pullback in January, to be honest. Like, just because I think people might want to wait to take gains and stuff like that, and, you know, and put off paying taxes on them.
Well, that's another thing I've been wondering about, is if some of the euphoria we've seen in a few names, particularly Bitcoin-related names, could be sort of a competition factor for broader equities here. What activity are you seeing on platform with Robinhood investors when it comes to crypto-related stocks?
Very strong. I mean, it's the one thing that we've seen probably act differently. Like, we've seen our customers, like, took profits in Tesla, for example, during the month of November, and started putting that money into some of the large cap tech names, which makes sense, right? Like, it's worked, and they've caught up. Our Robinhood Investor Index has caught up in terms of returns on a year-to-date basis, simply just from the month of November. It sort of had double the amount of returns. But in names like MicroStrategy, that's where it's actually been very different. They haven't necessarily been, you know, playing the volatility and selling, trimming winners there. They've just kind of been holding on, and even having it a place be net buy.
Is that something you see, though, carrying through?
I think so. I mean, I think a lot of expectations of what could happen in the crypto industry are already in these names. So I think we have to see what actually comes to fruition. I would hate for this to be buy on the rumor, sell on the news kind of situation. But if you do have something like come in, like the Bitcoin Act that has been floated around, like that is really huge for the entire industry and makes it way more viable for a lot of institutions who've probably just been watching.
Yeah, that's a great point. Stephanie Gill, thank you so much for taking the time.
Thank you.
Coming up, we are looking at today's trending tickers. We're going to give you the news behind those moves. That's coming up next on Catalysts.
Yahoo Finance has been releasing its coveted annual Company of the Year award since 2014. We'll reveal a winner in the following categories: Company of the Year, Surprise of the Year, Product of the Year, and Comeback of the Year. Be sure to tune into Yahoo Finance starting December 16th for the big reveal. Trust me, you won't want to miss this stuff.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and the worst performing stocks of the session. That's with the Yahoo Finance's trending tickers page. First up, let's take a look at Apple. Apple is reportedly set to begin producing its AirPods in India in the first quarter of next year, as the iPhone maker looks to expand outside of China, further diversify its operations. AirPods will be the second major Apple product to be assembled in India. That comes after the iPhone. Again, this really expands on the fact that Apple has been looking to diversify its manufacturing network. They have been relying more and more on India. We've covered the fact that India has been offering subsidies, obviously a skilled workforce. You to talk about some of the technological capabilities and advances that we have seen in India. So Apple has relied a little bit more heavily on the country. We also talk about, Maddie, the fact that President-elect Trump is returning to the White House come January. A lot to talk about what exactly the geopolitical relationship is going to be, the risk, especially when it comes to the U.S.-China relations. Obviously, when you think of a company that could be caught up in the crosshairs there, just in terms of some of the blowback that could ensue, I think many people, many investors will think of a name like Apple. So I think you can make the argument or the jump here that we could see Apple maybe place a little bit more of an emphasis, like we have seen in recent years, trying to diversify their supply chain out of China, away from China, to be a little bit less reliant than they have been in the past.
It's an important example of how these tariffs don't necessarily lead to any sort of stateside moves from these companies, right? They're going to look for other countries in the APAC region here. It's interesting, too, because this follows subsidies offered by Prime Minister Modi to increase some of this tech presence in India. But, of course, we know what this is about. As you perfectly laid out, Shauna, this is about a preventative measure ahead of those Trump tariffs, most likely here. We do know already that Apple sales in India have gone up over 33% to a new record high as of late. And, of course, that comes ahead of this second product of the AirPods being produced in India, following, of course, the iPhone. All right, next up, Amazon is the latest tech company to donate to Trump's inaugural fund, and I should say that matches Meta's donation of $1 million. The company will also stream Trump's inauguration on Prime Video, a separate in-kind donation worth another $1 million. I think it's really interesting and right to point out the $1 million amount from both Amazon and Meta, because that's nothing for these companies, but it is a symbol of them kind of being able to kiss the rain ahead of Trump 2.0. Something that I think is fascinating here is the reaction function that we have seen from these big tech companies to Trump 2.0, and this is something the president-elect talked about at the New York Stock Exchange, the idea of a friendlier reception this time around. Neither one of these companies donated to the inaugural fund the first time around, and if anything, the reaction function was a little bit more negative. You had the Women's March, several protests planned around Inauguration Day in 2016. We're seeing a very different response in Trump 2.0, especially when it comes to some of these big companies.
Yeah, exactly. We certainly have seen more and more tech executives that really start to try to cozy up to Trump, or at least improve relations when you compare it to some of the tense relations that we certainly saw play out during the first term there under President-elect Trump. When you take into account what this ultimately means, there are reports that Jeff Bezos is going to be meeting with Trump next week in Mar-a-Lago. So this donation will be coming, or this announcement here, in either coinciding with that or obviously leading right up to that expected meeting that is that is going to take place. That's according to reports here from the Journal. But I think just looking ahead, just what ultimately this means for the broader tech landscape. We know the Trump administration, not only was President-elect Trump very critical of the Trump administration, very critical of the tech industry, just in terms of his rhetoric and some of his commentary, and often targeting many of these executives and their companies, just in terms of his either personal or more broadly speaking, criticisms, policies, exactly, was huge here for the Trump administration first time around. I think second time around that could be a little bit different. We're seeing that lots of questions about what exactly policy is going to look like, what exactly antitrust regulation is going to look like, which we know, of course, has massive implications for some of these larger names.
Absolutely.
All right, let's get a check in on chip stocks. Broadcom surging 20%, lifting other names in the sector. That includes NVIDIA and Marvell. We talked to Stacy Raskin. He's an analyst over at Bernstein last hour talking about this, and I asked him ultimately what a blowout quarter here in terms of the guidance from Broadcom, what that ultimately means for other names within the sector. When you take a look at Marvell, when you take a look at NVIDIA specifically, and he was talking about that outsized demand, and what we are hearing from Broadcom, what we did hear from Broadcom executives during the earnings call, and he said it was, quote, a rising tide that lifts all boats. He sees this as very, very bullish signal here for many of these AI players. We talk about the fact that many of them have really been pacing the gains here over the last several months, 12 to 18 months, when we talk about the second stage or the stage here of the bull market rally. So looking ahead to next year and some of that demand where companies are still willing to spend, many of them are turning for that CapEx towards technology, towards AI, and we're seeing a number of these names obviously benefit as a result.
Absolutely. I mean, take a look at Marvell, up nearly 10% on the day off of no fundamental news for that company. It's about Broadcom, and the number that stands out to me, 220%. That is the AI revenue growth for Broadcom year on year. And to your point, Shauna, another proof point for the market that the AI CapEx story is one that is going to continue heading into next year. I think it's really interesting that NVIDIA is not seeing more of a rally today, perhaps off the back of kind of broader market pressures, though we do see the Philadelphia semiconductor sector index that's up over 3% today after being under pressure for a little bit of seasonality, but weaker than seasonally expected sales on broader chips outside of AI. So interesting to see that sector getting a little bit of a recovery today too.
Another story that we're following today, United Health Group CEO penning an op-ed in the New York Times 10 days after United Healthcare CEO Brian Thompson was shot and killed in New York City. CEO Andrew Whitty writing, quote, "The healthcare system is flawed. Let's fix it." He goes on to say, quote, "that we understand and share the desire to build a healthcare system that works better for everyone."
And we're following an update on the man charged with the killing. United Health Group confirming in a statement that Luigi Mangione was not a United Healthcare member. New York police originally said they had no indication that he was a client of the insurer before it was then confirmed by the company itself. Mangione remaining behind bars in Pennsylvania as he fights extradition to New York. We're going to bring you updates on this story as they come. Stick around. We're going to have much more ahead right here on Catalysts. Google hit a major milestone this week with the announcement of its breakthrough quantum computing chip called Willow. Google says Willow can solve a computing challenge in less than 5 minutes. Let's put that into context for you. That same challenge would take one of the world's fastest supercomputers 10 septillion years to complete, and that, by the way, is longer than the entire universe has even existed. The crazy fast capabilities of quantum computing will be indispensable for training AI models, collecting data, and modeling systems. That's according to Google Quantum AI's founder. He hopes it will enable breakthroughs in medicine, batteries, and energy alternatives.
And Wall Street is starting to catch on. You've got shares of Alphabet surging more than 12% since Willow's announcement. And they're far from the only Mag 7 name that's interested in this new technology. Microsoft, Nvidia, and Amazon have all made headlines recently, but their investments in quantum computing. All that attention has been huge for quantum stocks. In less than 2 months, 4 names in the quantum computing space, you got IonQ, Quantum Computing, D-Wave Systems, and Rigetti Computing, have all seen their combined market caps surge 171%. Now, for context, the combined market cap of the Mag 7 names grew just 14% during that same time period.
Though more broadly, quantum stocks, they've been under a bit of pressure. Currently, none of them operate at a profit. Both D-Wave and Rigetti have faced stock delisting multiple times due to low share performance, and the runway for mainstream adoption of quantum is a long one. Still, according to a recent study at McKinsey, 72% of experts in the quantum computing space still expect to see a reliable quantum computer by 2035.
One of the companies in the quantum space, D-Wave, recently completing a $175 million stock sale to further fund development and business operations. Joining us now, talk about that and more, we want to bring in CEO Alan Baratz. Alan, thank you so much for taking the time to join us here this morning. Your stock has been on quite a run, to say the least, over the last several months. Let's just take a step back and talk about some of this excitement surrounding quantum computing. I think so many of our viewers at home are still trying to wrap their minds, including me, around what exactly this is, what it ultimately means, why investors care so much about this. Put this in the simplest terms possible. What is such a big deal about this advancement?
Sure. So first of all, Shauna and Madison, thank you for the opportunity to speak with you today. The reason why there's so much interest and excitement in quantum computing is, first of all, it has the potential to solve problems better than they are currently being solved. So for example, optimization problems in supply chain or workforce management can be solved better and faster than they're being solved today. And then it also has the potential to solve problems that are not being solved today. Things like designer drugs. We can develop a drug specifically for you.
Okay, that's super helpful context then, but what does that mean in terms of Willow for the industry, right? Because we've seen Alphabet on a tear this week following that announcement. Why is there so much excitement about this?
Yeah, so the Willow announcement is interesting. Basically, what Google has done is they've demonstrated the ability to do some partial error correction on their quantum processor. And then they've repeated an experiment they did several years ago, but with better results than they got several years ago using that partially error-corrected system. But there are still a lot of hard problems that need to be solved before we get to full error correction and before those types of systems can actually be used to solve real-world problems. But that's quite different from D-Wave. D-Wave took a different approach to quantum computing, and we are commercial today. In fact, we're the only quantum computing company that is able to solve real business problems in production today, and we're doing it with companies like NTT Docomo or Ford Otosan in Turkey or Pattison Food Group in Canada.
Alan, what are those problems?
Yeah, so broadly, they are optimization problems. So these are things like workforce scheduling or optimizing how you assemble automotive bodies or protein folding. There's a broad class of problems that fall into the category of optimization. And in fact, Heather West from IDC just recently wrote a report where she said optimization could be the long sought killer application for quantum computing. And that is exactly the class of problems that D-Wave systems were designed to solve, and we are solving them today for our customers.
Alan, talk to us just about, we certainly have seen it act as a catalyst for a name like yours, a stock like yours specifically, obviously for Google, when you take a look at some of the larger players within this space. How big of a difference does it make to the bottom lines of these companies that are implementing this technology, that are able to use this to solve some of its problems? What does that ultimately mean then, just in terms of that longer term payoff?
Yeah, I mean, ultimately, I think it will be very important because, as I said, quantum computing unlocks the ability to solve problems much better and much faster than they're being solved today, and to solve some problems that are currently unsolvable. However, almost everybody working on quantum computing is still in the heavy R&D phase, and it will likely be many, many years before we see scaled systems of that class that can solve those problems. But I have to reiterate, that's quite different for D-Wave. We did take a different approach to quantum. We have the largest and most powerful quantum computers in the world today, and we are currently solving these problems for our customers and generating a solid ROI for them.
But I'm curious, for investors then, why should they invest in a technology that is so far out? And I get that it's a long-term play, but you look at a company like NVIDIA, far before they were winning on AI, they were winning on video games as a way to return profits to their shareholders. A company like D-Wave facing multiple delistings, still not profitable. Why should investors trust the company?
So I think, first of all, it's the huge upside opportunity that we are pursuing. Secondly, I would agree with you that for most of the quantum companies that are still in a heavy R&D phase, it's likely going to be some time before we see that drive to building the business and profitability. But we've started down that path. We already have customers that have applications in production. We have other customers that are working to move applications in production. And I think that as a result, we are today single-handedly building the business for quantum computing. And as a result, you can have a bit more confidence in D-Wave and its ability to achieve that goal in a relatively short time frame.
Alan, is the AI rally a friend or foe of quantum computing names? Because this morning we've been talking a lot about Broadcom, the surge in revenue due to companies continuing to spend on AI. What does that mean for quantum names?
Yeah, there's a lot of synergy between AI and quantum. The way I think about it is that there are three areas in which AI and quantum work together. The first and most obvious is that each can work side by side to solve a problem synergistic. For example, you might use AI to predict product demand in the future, and then use quantum computing to optimize the supply chain to meet that demand. So this is the two working together synergistically. Second, we are doing a fair amount of work right now on how quantum computing could be used as part of the model training and inference for AI. But because of the fact that it's so much faster than classical and requires so much less power, we think that we may be able to support model training and inference with much lower power consumption than what's happening today, which could be a game changer, and maybe we won't need to see companies investing in nuclear power plants. And then finally, models on quantum distributions rather than classical distributions may allow for more accurate models.
Alan, when we talk about the roadmap for quantum computing ahead and what that adoption looks like and who is interested in this technology, I mean, that's one of my biggest questions. Are you mainly seeing this from some of the other tech players that obviously have some involvement, are a little bit more familiar with it? Are you seeing interest outside of that industry? Give us a better idea, maybe what that looks like up until this point and how you see that, more importantly, evolving then going forward.
Yeah, so look, I think all of big tech is invested in quantum. And at the same time, there are 50 or more small companies that have been created to pursue quantum computing. Many of them trying to build quantum computers, many of them working on software and applications for quantum as the systems mature. So it's very broad-based right now. And the reason is because of the huge upside opportunity.
All right, Alan, we got to leave it there. Thank you so much for joining us this morning. We appreciate it.
My pleasure. Thank you.
We're going to have all of your markets action ahead. Stay tuned. You are watching Catalyst. And as we head to break, we're going to get a check on MicroStrategy as the Nasdaq 100 will announce changes to its annual makeup. Among the most speculated stocks to be included in the index moving forward is MicroStrategy. You can see here shares up 1.9%, and part of the reason that we are anticipating, and that some investors, I should say, are anticipating MicroStrategy being added to the Nasdaq 100 is just the severe rally that this company has seen year to date. It is up over 480%. Of course, the majority of that rally coming in here following the election of President Donald Trump. After Election Day, the stock was around $227. It's now nearing $400, as you can see on your screen. We're going to have much more ahead right here on Catalyst. Keep it here.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator.
Welcome to Capital Gains. We're off for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts. Yahoo Finance has been releasing its coveted annual Company of the Year award since 2014. We'll reveal a winner in the following categories: Company of the Year, Surprise of the Year, Product of the Year and Comeback of the Year. Be sure to tune into Yahoo Finance starting December 16th for the big reveal. Trust me, you won't want to miss this stuff.
Warner Brothers Discovery is the latest media company to announce restructuring plans. The company plans to create two operating divisions, one focused on the cable TV business and the other on streaming and studios. Our very own Alexandra Canal joining us here on set with more. Ali, always big moves in your beat here.
Yes.
The latest name to kind of shove off part of its news and streaming division. Tell me what we know here.
Yeah, so we know, like you said, a linear networks division and then studios and streaming. So linear networks for Warner Brothers Discovery, think news, sports, scripted and unscripted programming like CNN, TBS, TNT, HGTV, and the Food Network. And then on the studio side, we have obviously their production company along with their streaming service Max, and HBO is reportedly going to also be included under this umbrella. But it's no surprise that this is really all happening right now. It wasn't too long ago that we heard from Comcast, which is also going to be spinning off most of its own cable divisions. And at the time, there was a lot of bullish sentiment on Wall Street that this could potentially serve as a roll-up vehicle for other beaten down cable properties. So Comcast has said that this separate company, which for now has been dubbed SpinCo, it's going to be on the public markets. It's going to be well capitalized. Perhaps this is a play for them to acquire this linear network division that Warner Brothers Discovery is now leaning into. So it's something that I think we saw investors being very optimistic about. We saw the stock close up more than 15% yesterday on the heels of this news. A lot of commentary on Wall Street. Jessica Reif-Ehrlich from Bank of America said that this is the first step of a multi-year process, which is going to unlock what they believe to be significant hidden value in WBD's business. So in other words, the linear networks, all the debt, all the cord cutting that's really plagued that side of the business has really been clouding what could be some really positive underlying trends. So I think this is something that we're going to continue to see from these other legacy media giants, and it certainly sets us up for a lot of M&A potentially next year.
You know, Ali, when we talk so much about M&A, I guess the question, and this is very broad-based here, but who would be the potential buyers of this, especially when it comes to the cable side of it, right? Like, there obviously has been a lot of emphasis and a lot of hope in terms of some of that growth on the streaming side. But what about the traditional side? How is that, or what is the read out there from analysts about how that plays out?
Yeah, and that's a big question. I remember when Paramount was going through its own merger, everyone was talking about, well, who wants to buy a dying linear TV business? But if you think about some of the other companies out there, like Nexstar Media Group, for example, they own the CW. Maybe they want to expand their footprint and get more exposure to the broadcast and network side. There could be private equity plays involved. You know, at the end of the day, there are still a lot of folks out there that watch their television via cable or broadcast. If you look at the latest Nielsen report, broadcast and cable still make up the majority of TV viewing. Streaming has certainly caught up and continues to kind of take that market share, but it's still a business that I think some folks out there find attractive. So that's going to be the big question heading into 2025. Who are the buyers, and what does this mean also for these companies that are focusing on their growth initiatives like streaming? Is this the time where we're going to really be able to tell who the winners and the losers are?
And Ali, one story that could impact the streaming giant Netflix from this week that I didn't want us to go uncovering is this complaint from the National Labor Relations Board against the Netflix reality show Love is Blind. And we're all obsessed with Love is Blind, so that's why it stood out. But also, I wonder if it could have any actual implications for Netflix in terms of costs for people who are coming on their reality shows. What can you tell us?
Yeah, it could have a big ripple effect for the reality TV ecosystem at large. Right now, this complaint is not a final ruling, but it could pave the way for these stars to be categorized as employees and therefore have the ability to unionize. So according to the complaint, the production companies behind Love is Blind had categorized the shows as participants, not employees. So that meant they didn't have the option to stage collective action. The complaint also said that the cast signed contracts that had, quote, unlawful non-compete, confidentiality, and stay or pay provisions. And if you follow this show closely, you know that some prior contestants have actually complained about mistreatment on set and have also complained about these contracts. Now, reality TV has always represented this gray area for companies. Are they employees? Are they personalities? Bethany Frankel has spoken at length about this, saying that they should unionize, they should be part of SAG-AFTRA. So this has been a conversation that has been in the Hollywood ecosystem for a few years now, and I think this potentially could set the stage. And if they are categorized as employees, to your your point, what does that mean for costs? What do they get paid? If they do unionize, what's the trickle effect down from there? So it's something to definitely keep an eye on, because I love my reality TV shows too. And I wonder what the impact could be over the long term.
Especially as we've also, coming out of the writers' strike, there was this emphasis on reality TV.
That saved really a lot of the viewing out there.
Yeah, 100%. So it's definitely going to be an interesting one for us to come to you with all of our questions on. Allie, thank you
I'll be the reality TV expert.
Yes, exactly. Our
Always.
reality correspondent. We appreciate it. Thank you, as always. We're going to have all your markets action ahead right here on Yahoo Finance, so stick around for more. You're watching Catalysts.
The Federal Reserve has its final meeting of the year next week. Here with what investors can expect to hear is our very own Yahoo Finance's Jennifer Schomburger. Hey, Jen.
Good morning, Shauna. That's right. The Federal Reserve on track to cut interest rates next week for the third time this fall. But the central bank likely to strike a cautious stance when it comes to future interest rate cuts next year in the face of stubborn inflation.
I think that they're more likely to follow through in December and then think about next year. And they had some opportunities to tell the markets, hey, you know, we're really contemplating a pause at this point.
All eyes will be on officials' interest rate projections and whether the central bank could scale back the number of rate cuts for 2025. Earlier this month, Fed Chair Jay Powell said that because the economy is stronger than the Fed thought earlier in the fall, quote, we can afford to be a little more cautious. Markets are looking at the Fed pausing rate cuts in January as officials take a breath to assess the outlook for inflation and employment next year. Recent inflation data have shown progress has stalled in bringing down inflation. Some Fed watchers also expect the policies of the new Trump administration to create even more tests for central bank policymakers. Back in September, Fed officials estimated 4 rate cuts for 2025. Former Cleveland Fed President Loretta Mester thinks the Fed could scale back the number of rate cuts next year to 2 or 3. EY chief economist Gregory Dacko also sees 3 cuts next year, but others like Morgan Stanley and Luke Tilley, chief economist for Wilmington Trust, think the median projection will remain at 4 cuts. Tilley notes that it would take many more for the median to move up to fewer than 4 cuts next year. Guys, one thing is virtually a sure bet for the markets, and that is a 25 basis point rate cut next week. Right now, odds better than 96% chance of that happening. Back to you.
Certainly as close to definite as possible. Jennifer, thank you so much. As always, we appreciate it. The FOMC isn't the only central bank in focus here. We heard from the European Central Bank, the Swiss National Bank, and the Bank of Canada this week, all cutting interest rates as inflation moderates and uncertainty around the globe continues to loom. Markets pricing in that near 100% chance the Fed will trim by 25 basis points next week, while the Bank of Japan is expected to hold steady for the 4th consecutive month. Here with how investors should play the global divergence in rates, we've got Vincent Delward. He is the Director of Global Macro Strategy at StoneX. Great to have you on here. So talk to me about this divergence that we are seeing. Central banks globally cutting ahead of the Fed potentially pausing as early as December. What is the significance of that divergence for U.S. investors specifically?
Well, I think the divergence is really coming from the fact that every major central bank is looking at something slightly different. In the Fed, for the Fed, it's all about inflation. This week's print was a bit too hot. They kind of dismissed it, but if we keep getting these slightly hotter than expected prints, it's going to be hard to cut more than once. I mean, effectively, December is baked in. For the Bank of Japan, it's all about the yen, and we've seen the yen weaken recently, which would also the case for maybe not waiting too long for a rate hike. And for Europe, it's all about politics. We have this very messy political situation in France, elections in Germany. My base case on all the three is that the Fed is going to be probably tighter than the market expects them to be because inflation is not coming down as much as they like. And in Europe, on the other hand, the European Central Bank might be a bit looser because the economic impact of the crisis is really felt, and that's really the only option. So I would be looking at 50 basis point cuts maybe in Europe, and the Fed cutting only once and then going on a long break.
How does that then impact your global growth projections, what you're expecting to see then next year? Any sort of adjustment then, given the fact, especially here in the U.S., that we might not have as an aggressive as the Fed, which could be good news, I guess, depending on how you look at it here, heading into the new year?
Yeah, I think in general, growth has been steadier and stronger than economists have expected for a long time. We're still getting the tail end of that. GDP, if you look at the Atlanta Fed GDP now model, we're running at 3.3%, which is really outstanding. I mean, when Scott Bessent goes out and says, I want the 3 threes, right? 3% GDP growth, 3 million barrels, and then 3% deficit. The deficit won't get, obviously, but the 3% growth, I mean, man, we've had it. This is 8 quarters at 3% growth. 3 million barrel, we also have it. So my general impression, the economy is good. And the Fed probably should be paying more attention to the inflation mandate than the labor market. We'll see labor market probably tighten a little bit as we restrict immigration. So that would really justify a cautious approach for the Fed when it comes to rate cuts.
Okay, so if the Fed should be focusing on inflation in the context of what you just said from incoming Treasury Secretary Scott Bessent, we are expecting a stronger dollar and a growth story moving forward here. I wonder how you're thinking about how a stronger dollar could dampen growth abroad and therefore cause more inflation in the U.S. that then the Fed is going to have to contend with.
Right. The stronger the dollar, the more of a problem it is for the Bank of Japan. Like I said, the focus of the Bank of Japan is on the yen. They're probably feeling a little uncomfortable with the yen at 150. So the stronger dollar makes them actually more likely to hike. For Europe, a strong dollar is actually good news. It means that it will caution some of the tariffs. It means that we'll keep getting these American tourists spend a lot of money in Southern Europe. The ECB would probably welcome the stronger dollar, and then the stronger dollar would honestly help the Fed as well, at least on the inflation front, by reducing import inflation. One area that we really want to pay attention to in the next CPI reports is going to be core goods. Core goods have actually ticked back up in the past two reports, and this is mostly import prices, and we saw that also in the PPI yesterday. Import price on core goods are coming back up, and if we see this continue, we're really not going to make much more progress on inflation, because you get your core services stuck at around 4 or 5%. Shelter is coming down, but not quick enough. So you really need these core goods to come down to bring inflation back. A stronger dollar would help, because we import most of that stuff. And that would also help somewhat mitigate the impact of tariffs.
You know, and this brings me to one of the points that stuck out to me in your notes that you sent over. You said that tax cuts, tariffs, and stimulus were the right policy mix back in 2016. When you take a look at that now, the trade-offs, you say, are going to be much harder in 2024. How much of that has to do with this call here, and what ultimately, I guess, why you see it playing out so differently over the next 4 years?
Yeah. There's no right and wrong policy in economics, right? It's all about what do you do and when you do it, most importantly. And in 2016, the 10-year yield was at 1.5%. Inflation was well below target. We had a high unemployment rate. We had effectively austerity under the Obama years, and then much greater austerity in Europe because of some of that crisis, and Chinese growth was running over. So we had really all this kind of unused capacity for fiscal stimulus and expansion. And when Trump came in with the big tax cut, spending increase, tariffs, that gave kind of the economy the jolt it needed, and most of that jolt came in the form of higher growth. Now, it was not all rosy, right? I mean, if you remember, we had a bear market in 2018. So I think investors are kind of, to some extent, forgetting how disruptive and chaotic a Trump administration can be. But my point in 2016 is that most of it was on the growth side, because we're coming from a situation of underutilization of economic capacity. If you fast forward to 2024, we have the exact opposite situation. We have a dollar that is massively overvalued. We have a deficit that's already 7% of GDP. We have a current account deficit that's at a record level. We have an unemployment rate that's extraordinarily low. I mean, it went up a little bit because of immigration, but that tailwind is going away. Yes, if you're going to stimulate, if you're going to put tariffs, if you're going to cut taxes, my concern is that instead of creating mostly growth, what you'll do is to create more inflation.
All right, Vincent, thanks so much for breaking that down for us, taking the time to join us. Well, that does it today for us on Catalyst. We keep it right here. Coming up next, It's Wealth, dedicated to all of your personal finance needs. Brad Smith has you for the next hour. Have a great week.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, we're talking to a portfolio manager about playing the markets in the last 2 weeks of the year. And Redfin's 2025 housing market outlook will discuss where they see mortgage rates heading in the new year. Plus, committing to a financial New Year's resolution. We'll discuss how to set financial goals and keep them in 2025. All that and much more coming up during today's show. But first, as we always do, 90 minutes into today's trading session here, we're taking a look at the Dow, the S&P 500, and the Nasdaq, seeing a bit of slippage as of right now. Fractional declines for the S&P 500 and the Nasdaq. The Dow flat just barely to the downside here. But we should remember we're still on track for a losing week here with this, and the Dow posting its longest losing streak since April. Joining me now, we've got Francisco Beto, who is the FM Investments Senior Vice President and Senior Portfolio Manager. I would love to know what areas you're really focused on with this backdrop and this setup as we head into the final trading weeks of the year.
Well, good morning. Thanks for having me. Yes, I am focused basically on information technology. That is my favorite sector going into 2025. And in second place, I would say very selected retail and consumer discretionary. In the IT space, companies like AMD, NVIDIA, Palantir, First Solar, I think there's all good, solid picks going forward. And in the retail space, I believe that consumers are out there, they're spending money for the holidays and so on. And Burlington Cofactor, BURL, is one of my top picks there.
And so all of these things in mind, is there one theme that you believe that we've seen play out in 2024 that could also permeate over into 2025?
Oh, it's definitely artificial intelligence, and continued growth in data centers. This is just the beginning of a long-term ramp up. So, it's going to carry into 2025, 26, and God knows when, I expect it to go on strong forever and then get into a cycle mode. By that, I mean that once you buy your chips and so on, 5 years from now, you're going to buy new chips to do even better. So, you have an updated PC cycle, so to speak.
So with that in mind, and I think you're kind of alluding to something that a lot of analysts have been trying to wrap their minds around, which is a chip replenishment rate, how quickly the burn off of chips would take place and thus require them to be replenished or replaced within some of the data centers as well here, and the pricing at which that would be anticipated to take place. So as you're kind of looking across your own portfolio, and even if that is the theme that is perhaps the most prevailing that could permeate over into 2025, what's your assessment of how companies would go about navigating the pricing landscape and make sure that investors are clearly not grappling with, but understanding that story?
Right. I think the story, the AI story, will be self-explanatory going forward. It's a little bit tricky to wrap your head around, like you mentioned. And I believe, and I've read some things that are people wanting it to see the benefits tomorrow, from an investment they made yesterday and so on. So they got to be a little bit more patient, but AI is a transformative technology. It's not just one thing, right? And to put it in simple terms, we're talking about learning, artificial learning. We're talking about speech recognition, sound recognition, vision. So if you think about all those things where they can put to good use, including image processing, let me give you an example just to make it my point here. If you have an empty lot sitting around the corner, and all of a sudden you can get this software and it has AI and it has all the rules and regulations in a module for the county, all of a sudden you can design a building and 10 or 20 different designs on that lot, all with the plumbing, the electrical, pretty much like this, because they're images at the end of the day following certain constraints. So that's an example how AI can really transform many different industries. It could be health, care, insurance, and so on. So I think this is just the beginning of it, and it's really hard for a lot of people to get their hands about where the future is. The future's never that easy to predict.
Certainly.
So, yeah.
I want to come back to one of the other themes that you mentioned as well here, and you talked about the consumer. I wonder what you're noticing among the consumer this holiday season and what that kind of spells out compared up against the resiliency picture that we've heard and witnessed out in some of the economic data readings as well.
Well, that's all good for now. Let's put it that way. Come 2025, there's talk about tariffs and things of that nature, and I am concerned about that. I think at the end of the day, the consumer is the one that suffers from those things. Right now, they're outspending, and they're looking for value stocks. For value in general. So that's why, like, for example, Burlington Coat Factory, they get other people's excess inventory. And this is what probably going to end up in 2025 with a lot of excess inventory as companies prepare for tariffs maybe and just overstock. They buy too much of things because it's hard to predict and it brings in volatility. So we'll see how that goes. And I think consumers will be impacted by that. So that's one of the risks going into 2025, and I'll certainly keep my eye on that one.
And so just lastly, while we have you here, we typically would have been, for much of this year, talking about the risk that the Fed has within this broader kind of portfolio makeup that you've been laying out. But it seems like the Fed's on the back burner now, and it's all focused on what you just mentioned a moment ago in the incoming administration, the risk of potential tariffs, and the unknown there. How would you be structuring your portfolio to outlast any of those potential threats?
No, that's a good question. So the way that we pick our stocks in our portfolio is we use a house-grown investment process, which we call quant active, which is basically a quantitative layer that looks at the hard numbers regardless of emotions, and then it follows it up by me. So we take a hard look at things and look where the market is at. But in general, what we're looking for is stocks that have accelerating earnings and revenues. No matter who's in government, you want stocks that are growing and that are generating legitimate profits, organically. For that reason, a lot of these semiconductor companies pop up. They just show up in our processes, and that's why the process is dictating to us that going into 2025, it's in great shape. It's because of that. The fundamentals are strong and the demand is there. So if you get into more speculative sectors like consumer discretionary, then you're going to have some bumps because of the tariffs and so on. But everybody's going to need technology going forward.
Francisco, thanks so much for taking the time here with us today. Appreciate it.
Thank you.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, we got to talk a little HSBC. They're seeing more upside for Costco here. That's their latest call, boosting the price target on Costco from $926 to $1,000. This is after earnings, and the rating remains a hold. The analyst citing strong execution both in store and online and touting shoppers across income groups. Membership fee income from price hikes has yet to be fully reflected, and Costco management believes its teams are ready to weather any potential tariffs from President-elect Trump. Next up, you've got Penn Entertainment upgraded to overweight from neutral at JP Morgan. The analyst sees Penn as a good investment because of improving free cash flow. Also citing ESPN's Bet, the online sports betting service, as the single biggest driver for the stock. The price target there was lifted to $27 from $19. And finally, Norwegian Cruise Line upgraded to overweight from equal weight at Barclays. Now the price target raised to $32 from $28, pegged to demand optimism. The analysts expecting another strong year for cruises and specifically pointing to Norwegian's smaller footprint, share of international U.S. travelers on higher price cruises, and its balance sheet, also one of the factors there. Well, the incoming Trump administration's policies may mean the Fed will not be able to avoid addressing the impact of fiscal policy. Yahoo Finance's Julie Hyman is here now with a closer look at the shift here. Hey, Julie.
Yeah, data dependent. That's been the buzzword for the Fed for a long while now. It might have to switch to fiscal policy dependent in 2025. And Jay Powell, of course, the Fed chair, he has been very adamant at many press conferences, both across the first Trump presidency, the Biden presidency, and now sort of looking ahead to Trump 2.0. He's been adamant that the Fed's job is to focus on monetary policy, to focus on its dual mandate of price stability and full employment, and not to sort of directly address fiscal policy. I mean, in the latest press conference that he gave, he talked, which was just a few days after the election, he said, we don't comment on fiscal policy. We're not going to talk about the election. But in the next year, the Fed might have to factor in that fiscal policy and then its effects on the economy. Well, why? Because we are seeing a potential fiscal policy that could be more inflationary. We talked to Torsten Slok of Apollo this week, and he laid out some of the reasons why.
What might be coming next year is that if the main three areas where new policies might be coming is lower taxes, more tariffs, restrictions on immigration, it happens to be the case that the textbook would be predicting that all those things should be putting upward pressure on inflation.
Of course, the textbook doesn't tell us what will actually happen. And the problem is around all of those issues, we don't know how they're going to play out. Will there be mass deportations or will they be more targeted? And even when you talk about immigration, there are both puts and takes when it comes to the effects on inflation, because more immigration can also cause an increase in demand for things like housing. When you talk about tariffs, will they actually be imposed across the board? On what countries? At what rate? Or will they be a bargaining chip? And then, of course, for tax cuts, will they be extended? Will there be deeper tax cuts? Will they be targeted at various areas? So all of these ways could affect the economy, and the Fed is going to have to address that. And then if you look at the backdrop that the Fed is dealing with here, we're looking at an inflationary environment that has effectively stalled. We learned that this week. We got a PPI reading that came in larger than estimated at 3.4% on a core basis, which is what the Fed typically looks at. That's wholesale inflation. Consumer inflation still holding steady at 3.3%. And then the PCE, core PCE, which is what the Fed really zeroes in on. We don't have last month's reading as of yet, but we'll get it. But the latest reading we had was 2.8%. The Fed's target is 2%. So Brad, put all of this together. You know, you have this backdrop where inflation is just kind of stalling out. It's not coming down to that last little bit to 2%. Yeah. You have all this fiscal policy uncertainty. Jay Powell might not want to talk about it, but obviously the Fed is going to have to factor in some of this stuff.
Yeah, absolutely. And we'll see exactly what the makeup of the FOMC going forward, even after Jay Powell, his term ends 2026. So he's still going to have to navigate through the first Trump year. And then even in the second Trump year, you're going to have a lot of talk about what that makeup for the FOMC could look like. Julie, thanks so much. Thanks, appreciate it. Coming up, we'll talk about the housing market and whether or not mortgage rates are expected to come down further in the new year. Stay tuned.
Costco set the precedent for membership-only models back in 1983. But what led to such success for the more than 40-year-old retailer? Beyond the Ticker takes a deep dive into the company's biggest moments. Back in the 1970s, entrepreneur Sol Price opened the first ever wholesale retailer under the name Price Club in Southern California. In 1983, Jim Sinegal and Jeff Brotman opened the first Costco warehouse location in Seattle, Washington. A year later, the iconic Costco hot dog was introduced. With the fixed price point it still has today, $1.50. In 1985, Costco went public at $10 per share. At the time, the company had 17 locations. In 1993, Price Club and Costco merged. And until 1997, it was called Price Costco, until it took on the name we know it as today, Costco. In the mid-90s, Costco introduced its private label, Kirkland Signature, named after its original headquarters in Kirkland, Washington. That business now worth $56 billion. In 1997, the company launched its e-commerce platform, Costco.com, bringing its low prices and services online. By 2014, Costco was the third largest retailer in the United States, with sales exceeding $110 billion and a net income of over $2 billion. And its presence and loyal membership-only model keeps growing, giving it the ability to raise its membership in 2024 for the first time since 2017, from $60 to $65 per year for 3 of its membership models. As of 2024, there are nearly 137 million members and 891 stores across the globe.
Mortgage rates for the week ending December 12th are out. Our very own Claire Boston has the numbers here for us. Hey, Claire.
Hello. So mortgage rates this week, we have 6.6% on the 30-year and 5.84% on the 15-year. So this is the third straight week of declines. You know, headed into the end of the year, this is a little bit more relief for potential home buyers, and it'll be interesting to see where things go from here.
Yeah, we've got a comment here from the chief economist over at Freddie Mac saying that the combination of mortgage rate declines, firm consumer income growth, and a bullish stock market have increased home buyer demand in recent weeks. You know, the Federal Reserve is expected to cut rates next week. How likely and how will weekly rates react to that anticipated decision?
Right. So mortgage rates are not directly tied to whatever the Fed does, but they do react based on expectations about future interest rates. And so what we expect to see is basically whatever the Fed says about what they're going to do in the future. That is what is going to determine where mortgage rates go from here. And, you know, inflation is still coming in a little bit hot. So that does beg the question of how much further does the Fed need to cut to keep the economy kind of stable here?
Yeah, looking at a little bit more of a statement here, while the outlook for the housing market is improving, the chief economist of Freddie Mac saying the improvement is limited given that home buyers continue to face stiff affordability headwinds here. And that's something we're waiting for to abate and ease just a little bit more from here.
Absolutely. It's a tough environment for potential home buyers. 6.6% is still pretty high.
Claire, thanks so much for taking the time, breaking down the numbers for us. Appreciate it. While mortgage rates are trending lower, our next guest expects things to tick higher again, with the average for the year approaching 7%. Here with her outlook for the housing market in 2025, we've got Daryl Fairweather, who is the chief economist over at Redfin. Great to have you back on the program. So what is the outlook as you're looking into the dynamics that could play out next year?
So we're expecting more of the same. We have seen a bit of a boost in demand recently, and we think that will sustain into next year, which will support more home sales, more price growth. And also the people who have been putting off selling a home for so long are finally starting to give in and list their homes. So we think the market will be a bit better next year, but not a whole lot given that mortgage rates still remain quite high.
What's the magic number that you're anticipating on the mortgage rate front where we could potentially see some averaging out?
Well, prices are already reflective of current mortgage rates, so we're going to see sales even with these high mortgage rates. If mortgage rates were to come down, say below 6.5%, something closer to the 5 range, then I think we would see a large burst in demand, more bidding wars, more price growth than even what we're anticipating right now.
Certainly, and taking a look at some of the predictions here as well, even as we're showing that 6.8% rate on the screen for our viewers here, you're also anticipating that home prices will still rise 4% in 2025. Why is that?
Well, a lot of people have been delaying buying a home, thinking that mortgage rates were going to fall. And now that it looks like mortgage rates are going to stay pretty much where they are, there's no reason to wait anymore. So even though rates haven't come down, we do expect more buyers to come back. Also, the economy is growing, and some people are really ready to buy a home and can pay in cash to avoid those high interest rates. So I think demand is going to be stronger.
Daryl, I wonder, especially as we've heard so many business executives talk right now about the incoming Trump administration and anticipating less regulation. In that environment, what does that kind of pass through to the housing market as well?
Well, housing supply is incredibly constrained by things like single-family zoning and red tape that holds up development. So if we did see any progress on that front where it's easier to build homes, especially those denser homes in the places where people most want to live in urban metros, then that could go a long way towards increasing supply and really juicing the overall housing market. But I'm not expecting that to be an overnight change. I think that will take some time to play out. And these high interest rates make any change that could happen, that will probably happen slower because builders aren't going to be eager to build if their borrowing costs are so high.
So what does that mean for renters as well? And what does the rental market look like looking out to 2025?
We think it's going to be a renter's market in 2025, that rents will stay flat as incomes grow, making renting more affordable. And that's because there are vacant units right now. A lot of construction that was started during the pandemic is still coming online, still needs to be filled with tenants. So there's going to be a bit more supply next year. And even though builders have slowed down, that delayed reaction means that the new units coming on right now, there'll be more of them.
You know, one of my favorite things to ponder and just think about for myself, and I imagine a lot of people out there are also thinking about this too, is just how dramatically we've seen weather really shift and global warming and climate change, and how that's also priced in, or at least playing into a little bit more of the thought process for potential buyers. How are you anticipating that might be a factor?
Well, for the longest time, Florida was an incredibly desirable place for people to move to because of its weather and because of its affordability. But both those things are changing. Florida home prices and rents are quite high now, and insurance costs are going up, making borrowing to buy a home or financing a home even more expensive. So that is making housing more expensive. And also, the state is not drawing as many people in because people anticipate that climate change could be a bigger problem moving forward. So Florida is still a relatively strong market, but it's not as strong as it used to be. And I think that there are real risks that it could weaken as the affordability situation worsens, as the climate worsens.
I want to get generational with it too here. As we're thinking about millennials and the makeup of new home buyers, Gen Z too, they're going to start to really look through properties, try to figure out where there are opportunities. So what are you seeing specifically among some of the younger cohorts of potential buyers going into next year?
Well, a lot of Gen Z is probably going to decide to rent next year because renting is more affordable in most of the country than it is to buy an equivalent home. But in some places, we're seeing quite a lot of Gen Z buyers, like in affordable metros, such as in the Midwest, that didn't really get all that expensive during the pandemic, are still relatively a good value. We're seeing more younger buyers there. And the older buyers, they're still going to Florida and Arizona, as they always have, even though the climate has been worsening.
Daryl, great to see you. Thanks so much for taking the time. Excellent insights as always. Appreciate it.
Thank you.
We're closing in on the end of 2024 and looking ahead to the new year. Vanguard is out with its 2025 economic market outlook. And here to dig in, we've got Kevin Kang, who is the Vanguard senior economist and head of economic research. Kevin, good to have you on the program with us. Let's start with your outlook for the U.S. economy next year.
Yeah, so we have three things for the next year. So the first one is that for the U.S. economy, our view is that we're starting from a position of strength. We, despite inflation not quite having touched 2%, have an enviable configuration of having a really strong economic growth and inflation having made a lot of progress in the disinflation, and at the same time seeing the economy stabilizing, full labor employment. So our view generally is that we are here in part because of Fed's good maneuvering all the way down here, but also the major contributors really are the two supply-side tailwinds, the first one being productivity growth. That was certainly above expectation. And then the second one being a surge in labor supply from migration flow. So that's our view for the economy going forward. Obviously, going into 2025, our view is that it's going to continue to a degree, but it really remains to be seen whether the strong supply-side forces will continue or to a degree wane. And then obviously the other sort of set of risks is what the new administration might do as we go into 2025.
You know, I think you guys titled this extremely aptly in Beyond the Landing here. Is 2025 when we will finally see any type of soft landing, hard landing, just the landing removed from the lexicon? Or do you think it still is a Fed that we're going to be watching and laser focused to see if they're able to orchestrate what we've all been hoping for in the soft landing?
So in giving our outlook the title of Beyond the Landing, our really nudge and encouragement is that to actually look beyond that framework of, is it all driven by Fed's ability, or are we actually here and now in large part because of the supply side tailwinds? And our view is that, our conviction is that, we want to attribute more of that credit to the supply side, the good fortune of having the supply side forces. So that's why maybe perhaps unlike a typical cycle, our view and then focus is to really watch what happens with those forces. So productivity growth, our expectation is that it'll continue to persist. And then on the labor supply side, that's something that there's probably a greater potential risk on both sides coming into the new administration.
What can we expect to see in the markets, and specifically in the bond market, from your anticipation?
So our view, we've actually never been this excited about the bond market as an asset class. It's been a really long time. So our view is that going into next year, and then even beyond next year, the neutral rate just has come up quite a bit. Since the great financial crisis, we've been so used to a zero lower bound, and then now after the hike, we've started the easing cycle. But our view is that it's going to be relatively short-lived. There's going to be a lot of pressure on the floor in terms of how much the rate can go down into next year. And the reason for that is there are a couple of structural reasons that have sort of developed over the years. The first one is the productivity boom that we've been experiencing. Our view is likely to continue, and then beyond next year, there is a quite big chance that AI will then continue to sort of take it into the next decade, which then means there's a chance of greater likelihood of high economic growth, and then high sort of a neutral rate kind of goes hand in hand with that. The other force is the debt to GDP ratio, the level of indebtedness that the economy has. That is just set to continue to grow. And the reason for that is our aging demographic for this country, and all the entitlement spending that is really committed to support that through the entitlement spending. And there's really only one way to do that, and that is to continue to issue debt. And it's already at a level that the bond market is watching very closely. And as we continue to kind of go down that path, that's going to, again, continue to put an upward pressure on the floor, on the yield curve. So that means that kind of translates into about 4% on the floor, on the yield curve across the maturity spectrum, medium term and potentially long term.
Yeah.
And what that means is, as an asset class, that's a really attractive yield. As you know, as we know, it'll also continue to play the role of ballast in the portfolio. So the last time we had that level of yield is just before the great financial crisis, almost 15 years ago. And that's why our view on the asset class has just gone up, and we're very excited about it.
Just lastly, and we only have a couple seconds here, but when we think about the equities market, what are you anticipating there?
So our view is that it's going to be a continuation of sort of the tension between momentum and valuation. Momentum being the momentum behind the haves, the Meg 7s of the world that have a lot of competitive moats, that have the ability to continue to grow their profit margin, and then also that are benefiting from the excitement and narrative of the AI transforming the economy. And then the rest of the companies, really the have-nots in the equity world, that have attractive valuation. And we know that valuation in the long run should play the role, and it probably will have the last word. But we are in a situation where things look too good to be true, but then we're perhaps searching for the reason why that story may not be true.
Kevin Kang, thanks so much for taking the time and for the insights going into the outlook for 2025. Appreciate it.
Thank you.
Coming up, everyone, we've got your Yahoo Finance market update. We'll check out how stocks are moving and run through 3 stories that you don't want to miss. Stay tuned.
We are 2 hours into the trading day. It is time for Yahoo Finance's Market Minute. Major indices headed for a losing week with the Dow up, but still on a track for its longest losing streak since April. Here are 3 trending headlines we are watching today. Broadcom shares hitting a new high today, pushing the company past the $1 trillion mark for the first time. The rally follows the chip giant's fourth quarter results, which showed strong revenue growth for artificial intelligence. Adobe shares are falling after TD Cowen downgraded its stock. Analysts lowered its price target from $625 to $550 a share, citing the company's inability to monetize its AI technologies. And buy now, pay later company Affirm is getting its largest ever capital commitment. Private credit firm Sixth Street investing in $4 billion worth of loans over 3 years. That is your Yahoo Finance Market Minute to keep you on track with the news you need to make smart decisions about your investments. For more on what's trending on Yahoo Finance, scan the QR code below. More wealth when we return.
The crypto market is attracting a lot of attention as Bitcoin is holding above that $100,000 level. So how do retail investors spot the right crypto investment? Joining me now with some tips, we've got Yahoo Finance contributor, the author of the children's book, ABC for Future Millionaires, and host of the Financial Freestyle podcast, Ross Mack, here with us in studio. Good to see you, man. Let's talk about this a little bit. Getting into the crypto landscape right now, even at some of these record highs, that we're still in the ballpark stuff right now?
Yeah, well, one, right, I think you have to understand, right, we do have a much more crypto-friendly administration coming in, and as a result, there's a lot of talk about crypto. And I think when it's all said and done, when you are actually doing the research, you have to, one, do the research. You have to do the due diligence to understand what you're owning. And I think that you have to look and say, what is the use case, right? You know, do the research, understand the project and the team. You got to say what the use case is, figure out what they do by, one, reading the white paper, and also get a sense of, do they have a strong community? See, you know, who's the team behind it, what their background is when it comes to crypto. And I think that's the one thing that's gonna help you understand, like, is this crypto actually solving a problem?
Right.
Right? Is this something that I believe I can own and is gonna appreciate in value? Not just a trade, but an actual investment that will solve a problem in years to come.
We are years removed from, of course, the rampant ICOs, the initial coin offerings. Some of them were very much just scams, but there are still scams that run rampant right now within the crypto landscape. Less than before, but they're still out there. How do you avoid those?
Well, one, right, anytime there is a crypto bull market, there are going to be some bad players that come in and try to truly get in quick, right? Obviously, we just saw one recently, a rug pull. The name is escaping me, but the coin itself was called Haktua. And I think at the end of the day, you have to just truly say to yourself, right, if it sounds too good to be true, and it just might, right? So once again, you got to do the due diligence. You have to do the research and see what the team does. Is this coin actually solving a problem? What's the use case? And then once again, once you start seeing people, you know, promising some crazy outlandish, you know, returns, right? Chances are, right, it can very well be a scam. But more importantly, never invest the money that you don't believe you can lose, right? Because when it comes to these meme coins, right, you got to understand that in bull markets, they go up pretty high, but in a bear market, they're the first to go down, and they go down very abruptly. So do the due diligence and understand, hey, it's a chance that I can lose this all. And if that's the case, then this is money I'm willing to lose.
Ross, thanks so much for taking the time here with us today. For more insights with Ross Mack, you can check out the Financial Freestyle podcast. New episode airs every Monday, 12 p.m. Eastern Time. Well, is inflation weighing on holiday jewelry shopping? We've seen consumers pull back on discretionary spending this year amid high prices. October's retail sales report showed spending on clothing and accessories down 0.2%. Now, in terms of pricing, the latest CPI report shows jewelry prices, they were up 2.5% compared to last year. Here with insight into the latest spending trends is Tom Nolan. He is the CEO of Kendra Scott. Great to have you on the program here with us. Just first and foremost, let's start right there. What are you seeing in terms of the mindset of the consumer playing out within the jewelry landscape right now?
Hey, Brad, thanks for having me. Yeah, look, I think that the mindset of all of us, I mean, myself included, is, you know, inflation definitely took a toll on people. I think people are being more careful and thoughtful about the dollars that they spend, but we've done a remarkable job as a brand with making sure the customer's our boss and creating a connection with them so that they're coming to us. And we've seen a significant spike in business as a result of that.
And so with that in mind, what's that meant for how you are putting price into the market right now?
We have a high value proposition. We always have. I think one of the core tenets of our business is a high value proposition. So whether we raise prices or not, we want to make sure that we have an affordable price point for customers. And I think one of the things we think a lot about, Brad, is the fact that 82% of the U.S. population makes less than $100,000 a year. 87% of the global population is in that boat. So we want to make sure we have something for everybody. And it's one of the reasons that we've had 42 over the last 46 months of almost double-digit growth as a brand.
Really interesting. And so within that growth, where are the biggest opportunities for Kendra Scott to really lean in further, knowing where the newer consumers and especially younger consumers are gravitating towards some products that are available through your company and the competitive landscape as well?
Yeah, I mean, look, we want to talk to everybody. And we have one of the unique things about our business, Brad, is the fact that my 16-year-old daughter loves the brand as much as my wife and my mom, right? So you've got a lot of diversity from an age perspective. So we want to make sure that we're constantly talking to each one of those constituents in a relevant way. And we've got 149 retail stores now today, and that is kind of the tip of the spear for us from an events and an experience perspective. We'll do almost 30,000 events this year in those 149 doors. So we want to feel like we're a sense of the center of every community that we work with, whether you're 16 or 66 or 86 walking into the door. So we have something for everybody.
You know, I see this featured on your site, and we know that this has had a lot of growth among younger consumers as well, is lab-grown diamonds. I wonder what you're anticipating within that realm of the business, even in your outlook for 2025.
Yeah, I mean, lab-grown diamonds are a core part of our business, and we launched fine jewelry several years ago. And from that value proposition that I spoke about a little bit earlier, Brad, I think it's important that, lab grown from a sustainability perspective is important, but also it allows a customer to get a price point that's attainable and achievable without sacrificing on quality. So we see every one of our constituents leaning into that, and we've had a lot of success with it this year around the holidays specifically. I mean, we've seen almost a 30% increase year over year in business on top of a 30% increase last year on business. And that's in almost every one of our categories across almost every one of our channels. So lab-grown diamonds, it just goes to the point of the fact that we do have something for everybody. The brand's been around going on 23 years now. I think what Kendra stands for and the inspiration and aspiration that she is attracts people of all walks of life coming in around the holidays, but not just the holidays, all year as well.
You mentioned the stores and the footprint that you have as well. What do you anticipate needing to do in order to monitor where their foot traffic is still remaining strong and where you're seeing, especially on some of the malls and department store areas, where there might be a little bit of a pullback or at least a reprioritization of needing to go somewhere versus going online and making a purchase now, as digital certainly has really reformed how so many executives in your position are thinking about that touch point?
Well, look, McKinsey came out in their 25 State of the Fashion report, and they said 75% of shoppers are more likely to spend more after receiving high quality experience and service. And we've centered in on that from the very beginning. So we plan to open north of 20 stores a year for the next couple of years. We've got lots of white space out ahead of us. And if we make a connection, we create a great experience with our customers, we're going to see that happen. And one of the things that we've done as a result, we've never waited for organic traffic to happen. We've kind of gone out into our communities and through events and through philanthropy, pulled customers into our stores. So we've seen 17% increase this year just in retail traffic alone. And I think while the industry's in that ballpark of low single digits, we're high to medium double digits. And I think it's because of the way that we connect with our local communities, and we're not just resting on the laurels of hopefully customers will come in, because we're out of control of that, right? So we have seen a huge increase this year across outdoor malls, standalone stores, and also indoor malls. In fact, our number one performing store this year was in the South Park Mall for Yellow Friday. We call Black Friday Yellow Friday here because yellow's our color, but it was in the Charlotte Indoor Mall in South Park. So we continue to be an outlier, and I think it's because the customer's our boss. We treat them the right way, and we offer a high value proposition, quality product.
Tom, just lastly, while we have you here, I mean, you've had leadership positions either on the corporate side or on the board side for companies and ranging, and our viewers are seeing a few of those. You were previously at Ralph Lauren, you were previously at Condé Nast. What has this pivot been like for you being at Kendra Scott? Do you consider a pivot at all? And what lessons would you give to others who are trying to orchestrate and make sure that their skills are transferable across so many different types of entities and businesses that they would want to work with?
Yeah, thanks, Brett. I've had a unique career. A lot of it's been on purpose, and this pivot has been amazing. It's been almost 10 years now that I've been on the board and also in an operating role here. But I'm a servant leader. I try to ask a lot of questions. I come with it from a place of curiosity, and I like being a teacher and a coach. And I think that served me well, not just here at KS, but it's served me well throughout my career. Humility is really important. I kind of came from nothing in my life. I'm the first person to graduate high school in my family. So I think that approach, and then hard work and perseverance and problem solving, and not acting like a know-it-all in the room. I don't think people really like that. I certainly didn't. So I've taken that approach. It served me well at Kendra Scott. We have an amazing army, filled with 95% female, almost 3,000 employees today. And watching this business grow over the last decade has just been remarkable. And it's been my honor to serve here. And in all the companies I work on serve on the board of or I've worked at in the past. But I think it's just a consistency, treating people the right way, asking questions, hard work. It's kind of basic tenets for success in any walk of life, for sure.
Tom, thanks so much for taking the time here with us today and some of those leadership lessons as well here. Appreciate it.
Thanks, Brad.
Let's take a quick look at the markets here as we are just over 2 hours into trade here on the day, and we're taking a look at the Dow Jones Industrial Average first. It's flat, but to the downside. But over the course of the month, let's bring that up here as we're taking a look at, we'll just take a look at the past 30 days here. And over the course of that 30-day period, we're down by about 0.1%. We'll continue to watch to see how the rest of this trading session plays out. Over the past month, 30 days for the Nasdaq Composite, you're seeing that up by about 3.3%. Here today, down by about 0.2%. S&P 500 also down right now by about 0.1%. Just briefly, I'll take a look at the 11 S&P 500 sectors. We've got them loaded up here for you on the screen. Right now, pulling up the caboose, you've got communication services down by 0.9%. Utilities leading the way. That's up by about 0.3%. We've got much more on wealth after the break. You're watching Yahoo Finance. Programming note, on today's episode of Warrior Money, Quattro Capital Managing Partner Maurice Philogene explaining how he got his start in real estate by investing and utilizing the VA benefits that he earned while serving in the Air Force.
Of course, with the VA loan, no money down, buy your residence. You can even think about it from an investment perspective. Just buy it at the point where if you are thinking about renting it in the future, just keep the mortgage at a level where the rent will cover. So I used it kind of as a flipping mechanism. Okay, I'm going to live in this for 3, 4, 5 years. I'll refinance it, put a renter in. I know that's an asset for the future. I'm going to go get another single family home with another VA benefit loan and press repeat. But nowadays I don't need to, but press repeat. But if you serve, you have all these tools and resources you can use. People just have to find them and use them to their advantage.
You can catch episodes of Warrior Money Fridays at 12:30 p.m. Eastern Time on Yahoo Finance or wherever you get your podcasts. If you're looking to set some new financial New Year's resolutions, I'm talking ones that you can actually keep here. Listen up. Joining me now with tips on how to set and achieve those financial goals for 2025, we've got Jordan Grummett, who is the host of the Earn Invest podcast and author of the upcoming book, The Purpose Code, How to Unlock Meaning, Maximize Happiness, and Leave a Lasting Legacy here. Great to have you here in studio with us, Jordan.
Thank you so much for having me.
Absolutely. So let's dive into this. Just on setting goals that you can keep and that are attainable, what is the first step that you could really take to lay this out?
Well, I think the problem is a lot of times we use financial goals and that's how we start goal setting, but I think we have to think about purpose first.
Okay.
And I think if we think about purpose first, we can then reverse engineer our finances and it leads to greater happiness and specifically a greater sense of control over the outcomes.
Certainly. So what are some attainable financial goals once you've figured out the purpose and why you're doing them?
So I think we have to start with the why. Okay. And the reason why is purpose is abundant. There are a million things we could enjoy doing, but money isn't always abundant. Sometimes it's scarce. And so we got to think about in times of scarcity, when we don't have as much money, what are the other tools we can use? How can we use our relationships, our connections, our youth, our knowledge to develop a life of purpose? And then when money is available, we need to go ahead and use that money to live that life of purpose. So it's all about what's important to us. What is that tool of money supposed to actually do for us?
Certainly. So then, once you've been able to identify the why, perhaps maybe even set the goal, what about coming back and checking in on how you're doing and measuring up against those goals over an extended period of time, too?
This is where the magic happens. Because once you know your why, then you can start looking at your financial goals. And so some of us who are really lucky can integrate our why into our jobs. And so we might not need as big financial goals because we're fulfilling a sense of purpose in our job, and we can slowly accumulate money. We're not worried about retirement because we love what we're doing. On the other hand, there are people who don't like their job. And so they have a few choices. One is they can build purpose into that job, but if they feel like they can't do it, then they might want to be more aggressive with their financial goals. Maybe you really want to max out that 401k. Maybe you really want to save some extra in your account. That's what we're really talking about doing, is trying to figure out what does purpose look like in your life and then building that financial framework around it.
Certainly. When you think about finding purpose, how do you make sure that you are also finding purpose in your career?
Well, here's the thing. I always tell people you don't find purpose, you actually build or create it. But we do need to know these inklings, these beckonings, these things that are important to us, and then we can build a life of purpose around it. So the question is, what lights you up? And when it comes to career, what I love to do is use something I call the art of subtraction. So I tell people, take your job and write out the 15 or 20 things, your roles, your responsibilities, and then take a pencil, a really sharp pencil, and just start scratching out everything you don't like or that doesn't fill you up. Now, most people, when they do that, will have one or two things left over. But those are the things that feel purposeful. So we can look at 2025 and say, well, I'm not going to leave my job. And I'm not going to say, I'm going to go find a job that brings me passion, because we all know not everyone can do that. But how can you maximize those things, the two things you really love in 2025? A great example. So let's say you work at a restaurant. And you don't like being behind the counter, helping people isn't your thing, but every Wednesday morning you stock the stock room for 2 hours and you love that. Well, if that's the thing that you've found from the art of subtraction, maybe Lucy, who also stocks the stock room on Monday and Wednesday and hates it, but loves being at the front counter, maybe you can switch places with her and convince your boss that, hey, I'm going to do this Monday, Wednesday, Thursday. You've tripled the amount of time that you're doing something you like and reduced the amount of time you're doing something you don't like. And in a sense, that's winning the game.
Jordan, we got about 30 seconds left here. How many financial goals should you set?
I think we should be really simple and set 2 or 3 basic goals. And I think they should be very purposeful. I think we should decide how the finances are going to support the purpose and the happiness.
Jordan, great to have you here on set with us. Thanks so much for taking the time.
Thank you for having me.
Absolutely. Everyone, that's it for Wealth. I'm Brad Smith. Thank you so much for watching. And stay tuned for Market Domination with Julie Hyman and Josh Lipton. That comes up at 3 p.m. Eastern Time. They'll count you down to and through the market close. You don't want to miss it.